Morning all. How are you all doing? How is everybody this fine Tuesday morning? Morning Danny, morning FTNet, morning was just morning Harold, morning Joey, morning Vitali. Never gonna get it right. How are you all doing? Morning CK. So yeah, today we're going to basically do some sort of back to basics stuff with position trading. Looking at support resistance and manual position trading, and also a way to use the position trader EA with manual trading as well, and scaling at support and resistance by adjusting the ADR distances and things like that. So it's kind of back to the way that I used to trade before I started using RSI to get into positions. So we're going to look at much more in detail on position trading, because some people have said they want to do more position trading stuff, which is fine, which is good, because that's basically what my main strategy is anyway. So just looking at the indices this morning, I've got a few bits to cover this morning before we do that. Where's my pen? There it is. So indices, we've broken long on the FTSE, broken short on the DAX. Had a terrible week this week so far. It's been hedge week. It's only Tuesday, but yesterday was really hedgy. Friday was really hedgy. So not had a good couple of days. So I'm hoping we get some clean breaks today. NASDAQ was okay yesterday. Made a nice profit on the NASDAQ, which paid for the Dow hedge. But the DAX and the FTSE both hedged yesterday, and I couldn't get out of them. Absolute rotation yesterday, literally. Absolutely nothing you can do with that yesterday. No one could make any money with that yesterday unless you were literally selling the high and buying the low. So one of those days. Morning Barry, morning Travel. How are we doing? Right, so just going to quickly kick off with news, because we've had some fairly decent movement overnight. I've banked 2% overnight on my CAD trades. So Aussie CAD, I posted them all in the Discord group. Just gone short on the Aussie CAD. Because obviously that is an ADR hit today, and I can trade that in both directions because of the swap. The Euro CAD, no, it wasn't in that. Pound CAD I was in. So out of pound CAD, that was 4 positions, 4 trades. 1, 2, 3, 4 out. New Zealand CAD was a double out there on those 2. And US dollar CAD out on the long. Obviously the EA got me out at target, which is 1 ADR. Obviously it's gone 3 ADR pretty much. So, but you know, this is part of automation. If you use automation, you'll get out when it hits that. If it hit that and gone down there, I'd be cross if I was targeting 3 ADR. Just take the money, basically. So that's decent profit on that one this morning. Everything else is just sitting there flip-flopping around at the moment. So today's news, again, very quiet day today. We've got the consumer confidence this afternoon, which is the only thing really that's going to move the market today. But this evening is where it all starts. So this evening and going into tomorrow, we're kicking off with FOMC. That's a biggie. Obviously, those meeting minutes are coming out. It's not a press conference, so it's really what's going to be in those meeting minutes. We're not going to get any forward guidance from the Fed from a question and answer perspective, but they will lay out in the meeting minutes what their thoughts are internally on whether or not they're going to increase or decrease interest rates and how fast. So with the meeting minutes, you either get not a lot of movement, but you get a whipsaw because there's no news, i.e. it's just what they've been saying all along being confirmed, or they will release something in the meeting minutes which is not expected, and then the market will take off in one direction or the other. However, at the moment, it's all about Trump. So what the Fed says is very important, but we don't know how much of that is going on at the moment with Trump controlling the Fed. So we'll see what happens. We've got Aussie CPI overnight as well. So that's forecast to pop. We've got the New Zealand rate as well, which is going to drop. So there's a lot of news. So after the market sort of closed in London, we got a lot of stuff happening overnight. Then we got GDP tomorrow. overnight news, obviously, the main focus was on the Canadian dollar. So two things happened yesterday. Oil price dropped dramatically yesterday. Not dramatically, shouldn't we say dramatically, but it dropped a lot. Quite a bit, ADR. So obviously that will weaken the Canadian dollar. And then Trump announced all the trade stuff overnight. So we got 10% going on to Chinese imports. I couldn't see anything about the CAD in here. But apparently somewhere he's mentioned that they will be more tariffs on Canadian stuff. But I can't actually see here. I don't really need to see because I can tell that something's been said because obviously the Canadian dollar's gone nuts. China, Mexico and Canada. There we go. The dollar rose as stocks fell as Trump indicated the US would slap extra tariffs on China, Mexico and Canada. There we go. So that's your only other overnight news. So obviously the Canadian dollar collapsed overnight. Whether that's going to continue or not, I don't know. I've got a short on the Aussie CAD now. So I've got a long exposure on this morning because it's popped. So we'll see. This is either an overreaction or it's going to continue. If it continues, I'll get in up at that resistance and then I'll get out when it comes back down. So there we go. So there's your overnight news. Morning, Evil. Morning, Segar. It's on Forex Factory. Yeah, it's not red. I would expect something like that to be red, as it was with China. I presume that he announced it at the same time, and what that should say is Trump to impose additional 10% tariff on China, also Mexico and Canada. Then it would make sense. But there's nothing I can see that mentions the word Canada. Apart from that news, apart from the Asian market wrap. So this is the market wrap. We have a market wrap 3 times a day. That's where it's mentioned. It's not mentioned anywhere else. So, anywho, so yeah, so big moves on the CAD. We'll see what happens with that. Morning, Mark. So just quick recap on the other strategies we've got in forward test at the moment. The pullback strategy is having a problem at the minute. It's just not able to get anything going. The problem with this strategy, this trend pullback strategy, is took a trade there, look, and stopped out. But it's basically reliant on the market trending, and this is the problem with trend strategies and why I'm not a fan of trend strategies. Although trend strategies work, I'm not a fan of them because the market spends 80% of its time not trending. So you can only make money if a market's going to trend. This isn't trending. It's not going to make money. So it's about minimizing the losses when it's not making money. So although this has got a $2,000 loss on it and it looks like a hideous strategy, if you actually look at what happens when this market or the markets go into a trend, this will bank a ton. So there's $1,000 worth of TP on these 2 trades alone. If both of these just pop, if the Swiss franc goes into a trend today for the next 2 days, it's going to get 50% of that drawdown back, just like that. So it is a very slow burner. It's a multi-day hold strategy. It's only been running for a couple of weeks, and it's just not had the right market conditions at the moment. So I'm going to give this more time to forward test. But it's just struggling at the minute because the market's not trending. There's nothing you can do about that, and it's not pulling back either. Look, if that had pulled back ever so slightly just before Trump said what he said, that would be hit target. But it didn't. So it's just annoying at the moment. It's an annoying strategy. Trend strategies have always annoyed me because they are almost impossible to make consistent money with. That one's a nice TP. Look, that, you know, we're looking for a couple of ADRs worth of push on it, which you get in a trend, and you know, one of those things. But anyway, so we'll keep monitoring that. The lazy trader strategy has got a nice load of exposure on at the moment. So it's all single trade exposure. Unfortunately, a lot of it is on the Canadian dollar. So if this CAD doesn't pull back, we might have a bit of a trouble, but we'll see. But it's kind of at a break even at the minute. It's been performing extremely well. We've had 2 days basically where it's struggled. So I think that 25th, if we have a look through the trades that closed overnight, why did that make a loss yesterday? Where are we? 25th. So we had a loser on the pound US. It's scaling out. So it's scaling out of the pound US. That's why it's made that little loss there. So yeah, again, this is reliant obviously on the opposite. This is reliant on the market being rangy and normal market movement. So again, both of these strategies have got nice long-term edges when the market conditions are right. When the market conditions are wrong, you stagnate or you draw down and then you fly. So, you know, there's 2 states to the market, range bound and trending. They'll do their thing when the markets are doing those things. So they're holding up pretty much as I expect and as I saw in back testing with them. So we'll see how we go. You know, like I said, with this one, it's a case of waiting for a month. You know, this will be gone very, very quickly. As soon as we get something take off, that will be gone and it'll be profit. But it's just, as I've said many times, the reason I position trade is because stop loss trading does one thing and one thing only. It stops you out. That's the purpose of it. You're putting an order in the market to say, if this trade goes the opposite direction to the button press, get me out of the market. And if that line is above that line and you are short, you get out with a loss. That's what it does. It's a stop profit order. And this is why trading with stop losses is so frustrating, because you will constantly get stopped out. It's death by 1,000 cuts. Nothing you can do about it. So it's to be expected, which is why you need to look at it once a day, once every couple of days, and leave it, because if you look at it constantly, it will drive you nuts. Right. And as you can see, position trading does the opposite. It also drives you nuts because you're constantly in drawdown there. So never win, can you? Getting squeezed hard on US dollar CAD. Are you still in that? Yeah. Don't know what to say, really. I mean, this is why I said get out before the election. Take the loss. Because if the election goes the wrong way, you know, this is, as I said yesterday, if you're in the live room yesterday, this is a reset as far as I'm concerned. Forget that. Yeah, we're now looking for this. We've had a 50% pullback, and that's taken off. This has taken off, though, not because of the US dollar. This has taken off because of the Canadian dollar. So if you look at the other US pairs, yeah, we had a little bit of a pop, look. Yeah, and Euro US, whoops. Little bit of a pop. So this is not the US, this is the Canadian dollar. Yeah. So what the market makes of this is a knee-jerk reaction to Trump saying we are imposing import duties on Canada. I didn't see anything about numbers or anything there. So this is a market reaction to, holy crap, let's liquidate our Canadian exposure and figure out what this is going to cost the Canadian economy. Oh, okay, it looks on paper like it'll be fine. The analysts will be working on this today, looking at it and thinking, right, how is this actually going to impact the CAD long term? If it isn't going to impact the CAD long term because the CAD will oppose opposite tariffs on something else, or they will up their oil export by the same amount as their import to America, it negates itself. Therefore, this will come back down. We'll get an A-shaped recovery. So you, with your US dollar CAD, if you're still in it, you could be back down here. I mean, it could be this afternoon, but I would say more likely after FOMC and tomorrow. Yeah. So this is potentially just a knee-jerk reaction. But potentially it's really terrible for the Canadian dollar. Don't know. But very difficult to tell. It's on the market NDX page. What's the market NDX page? I don't know what that is, Jules. Where's that? Post a link. Finally bailed out in US dollar CAD with a big loss. Yep, you have to do it sometimes. I'm running on your RSI 10 H4 set file on demo account. 12 pairs made 10% this month. Good job, Vitali. Yeah, RSI 10 on 4 hours is a good RSI. It's nicely balanced. That at the moment, though, you know, this is partly what we're going to be doing today. Yeah. Position trading is all about scaling in and out of movement. And the trouble with indicators, we'll go into this in a second, but I'll talk about that in a minute. US dollar CAD rises above 140 as Trump announces to impose 25% tariff. 25%? Wow. Why is that not on Financial Juice anywhere? I don't understand why that isn't in here, because that's massive. It's not here. It's weird. It's like Financial Juice has I feel like Financial Juice has let me down. But anyway. Yeah, so nothing you can do about that. Just take the loss, move on with the US dollar CAD if you want to. But you know, I took a 10% loss overall on it. I made a big loss on it, and I made a nice profit, which negated some of it, which left me with a 10% loss. So sometimes you just got to do it. You know, it squeezes like this. And this is why getting in small is so important with position trading, because you do not know which way the market's going to go, and you don't know how fast it's going to move, how long these moves are going to take. So, but anyway, so right, we'll get on to the position trading bit. So that's basically today. RSIs and ADRs, obviously today you've got to kind of ignore a little bit because you know it's lit up like a Christmas tree. Because obviously we've had the Trump effect, and this is what the new norm is now. So if you've been trading less than 4 years, yeah, you haven't experienced a Trump presidency. If you've traded for more than 4 years, you know what's coming. Yeah, this is what he does. He opens his mouth, the market explodes. It's going to be a completely different way of trading over the next 4 years, because he does things very, very differently. He acts, then he thinks. Yeah, not the way you should do it, but he uses social media to tell the world what he's thinking before his staff know about it, right? Which means that the market suddenly goes, what? And you get panic, and then they verify. And so basically you get panic, they verify, and either continue or undo. Virtually all the time, that's what happens, because he causes mass panic. The market looks at it and goes, what's he on about? And then someone from the White House comes out and says, no, what Mr. Trump meant to say was, boom. Exactly the same way as the Fed do it, yeah? You get one member of the Fed come out and say one thing, and then half an hour later, another member of the Fed comes out and says totally opposite thing. You get the stock market hit ADR and bounce back down another 2 ADR. Yeah, it's all the talking head stuff, and he is the big talking head. So this is what I'm saying with this move we were seeing on the Canadian today. He's threatening to impose that, but there'll be intricate details within that we don't know yet. So the market will basically liquidate, think, analyze, and then re-establish the position if they need to. Yeah, which is why you should find those recoveries. However, we're early on in his presidency, which we haven't even got to yet, and he's already causing this. Yeah, so we're early on. This could be a continuation one, this one, because this is new. We don't know about it, and it is likely to have a negative impact. But you also have to look at the Canadian economy in respect of, with the CAD, a lot of their money is made from oil. Yeah. So if he is imposing 25% duty on imports from Canada to the US, and with Canada's GDP, 1% of it is reliant on US exports, this doesn't affect the Canadian dollar at all. Most of the Canadian export money is made from oil exports to other countries, not to the US. The US is a net oil producer. It doesn't need to import oil. Yeah. So it could be that Canada exports wood and it makes 1% of its GDP from wood imports into the US. It's not going to touch the sides, is it? Yeah. So again, don't be panicked by this move, because until the analysts have sat down and go, right, let's have a look at what actually exports from Canada to US and what impact that's going to have, and how can Canada offset that. So they basically say, right, well, you guys export a load of stuff into us, we're going to stick 5% on because we get more of that and you get less of this. They balance out. There is no impact. Yeah. So it's all knee-jerk reactions. It's what the market does. It scares. It's fear and greed. So don't worry too much about it. Harold, you've got a green star. Jules has got a green star. That means you're 3 months in, isn't it? Is that the 3-month star? You've got the 3-month star. Well done. You've stuck with me for 3 months. That's good. I've seen your P&L. I'm not surprised. Because you're position trading, which is what we're going to talk about this morning. If I stop rabbiting on, it's 20 minutes in and I haven't even got to the subject yet. But we do need to do the analysis. So, right. So, position trading. Let me get a nice, clean chart. There we go. Nice, clean chart with no indicators. Yeah. So what we're going to look at this morning is the basics of position trading, if you like, and market structure. So the actual subject of today, if I stop myself, is position trading using market structure without indicators. Yeah. So what we're going to cover is basically how the market moves with market structure and what market structure is really, and how to position trade within market structure. So when a market is moving, this is oil, it's going to gap, so that's not a good instrument to use. Let's use something really simple like pound US dollar. So when the market moves, it moves using a structure, and the structure can be one of two things. Yeah, it is either going to be a structure which is balanced, yeah, and the balance will have different highs and different movement within, and you know there's lots of stuff going on inside of that, or it will be one of those. It's either doing that or it's doing that. Yeah, there's really only two things it does. It either sits sideways because we've got equilibrium between the currencies with Forex, or it's trending because we've got imbalance. Yeah, so there is a reason why one economy is stronger than another, why one currency is stronger than another, or there isn't. That's it. There's only two things that happen in the market. It goes up and down, and it either goes in one direction or it goes sideways. That's it. So what we need to do is identify ways to extract money from that market movement, because we can't predict market movement. We can't time market movement. We can't predict distance it's going to travel, but we can predict whether it's going to do one of the two things, which is either go sideways or go up and down. And even if we get that wrong, it doesn't matter. As long as it's moving, it gives us opportunities to exit. So when you're looking at position trading, the idea of position trading is that we are allowed to get it wrong a number of times. That's the whole advantage of position trading, is that we cannot predict market turns. It's impossible. You cannot predict distance of movement. You can in some extent where you're using Fibonacci extension ratios and things like that, or measured moves, but that works sometimes and sometimes it doesn't. So the advantage of position trading is that we adjust our price. So if we were to get into a long trade here because we thought that this massive move down was going to mean revert and it doesn't happen, what we can do is we can take a second trade at an area which has been reactive in the past and move our price to a new price, which is more beneficial to us. And we just sit there and we continually do that until the market moves enough that we can get out of our trade. And that is position trading in a nutshell. It's super, super, super simple. So the way that you tend to do this with automation is you need a set of rules. So with position trading with the position trader EA or the market reverse alerts EA, the best indicators I found to measure extended movement for mean reversion were the RSI and the average daily range, because these are measuring strength. Yeah. So when you go beyond the average daily range, we've got a bigger than normal strength day, which means that the market is exhausted and you tend to get a pullback. Or when we've had a relatively strong move in multiple days, hours, weeks, whatever time frame you're operating on, you get an RSI extension down here. It means that the market's moved a long way and it's likely to need to pull back. So the initial entry is taken because of a market condition, and this works really well in trending markets or markets that are moving in a direction. So that is probably one of the best examples of market structure, which I'm now going to ruin. There. Yeah, it's very, very simple market structure. You've got a low, a high, a higher low, a higher high, a higher low, a higher high, a higher low, a higher high, until you haven't. You've got a higher low, and then you don't put in a higher high, you put in a lower low. Market structure break. Yeah, that's market structure. That's how it works. Yeah. So when you're trading market structure without indicators, all you're looking to do is get in a direction with the assumption that one of two things will happen. It will either continue to do what it's been doing or it won't. It's binary. Yeah. So whenever you take a trade, the way that I used to do it was every time I enter a position, I am planning the next move straight away. Now, the position trader EA and the market reverse alerts EA does this automatically by saying, when I get into a trade, if the trade goes my way, I will take profit at X, and you set the target to an ADR, half an ADR, quarter of an ADR, 1%, 0.5%, whatever you want. So basically, if the market continues to do what I'm expecting, I take the money. That's it. If the market doesn't do what I'm expecting, I wait for it to move a distance before I take a second position. The problem with this is there are often areas that you can identify that means that the market can't get past. So for example, let's say we took a trade long here for some reason, and we said, right, I want it to move an ADR down before I take my second position. If there's a strong area of support or resistance before your next position, you won't get to it. Yeah, so you can't take that extra trade. So the way that I used to do it was I used to literally just look at the chart and draw in support and resistance zones and use those as my second entries. Yeah, so you take an initial trade, and instead of using ADR, you just use wherever the next support resistance area is, in which case it's here. Yeah, so it came down and it hit that support resistance. You take a second entry there, and then it popped. Now, it doesn't matter if it goes like that or like that. In this case, it went down. What we're looking for is to get out of our trade. We got an exit. Yeah. So the easiest way to do this, and there's two ways you can do this. You can do this manually, very, very easily. You can use limit orders if you want to. Now the position trader EA has the limit order buttons. Yeah. So you can use sell limits and buy limits, which you can use to place at support and resistance. Or you can do this manually if you're not using position trader EA. It's just you'll obviously have to manually set all your targets and do everything yourself, which is fine. But what we're going to do is look at exactly how to draw in the support resistance and how to plan the trades. And the planning of the trades is the most important part. Yeah. So whenever you take an entry, the first thing you should be doing is saying, right, if this works, where am I going to get out? If it doesn't work, where am I going to get in? So I'm just going to pick another pair that's got, actually, this is not a bad pair to start off with. We use a 4-hour time frame just to start off with, but I want to also do the same thing on a more range bound pair, because this is a little bit trendy at the moment, or was a bit trendy before it stopped being trendy. So let's go back in time and just pick, I don't know, we just start here, for example. And just pick an area, basically. So what I would do is literally place a line where I see, so let's pretend this is the hard right edge. Actually, let's go forward a bit like that. Let's pretend this is the hard right edge here. So all I would do is without using indicators, just look for areas of support resistance, which are absolutely obvious. Yeah. So every morning, open up the charts, and depending on what time frame you're operating on, hourly and 4 hourly, daily if you want to, but I wouldn't go much lower than that as a time frame. Look for areas of support and resistance. Yeah. And basically you've got two options. You can either place a pending order at those levels, which is the way that I used to do it before I created the market reversal alerts EA, or the market reversal alerts indicator rather. And then as soon as the market gets there, you are assuming that you are going to get a bounce at that area, because you bounce there, you bounce there, you bounce there, you bounce there. Chances are when you get there, you're probably going to find some level of resistance, because the banks have had limit orders sitting at that level a long time. If they're still short, there's still going to be limit orders triggering. So all you're looking for is to get a bounce out of it to take some money. If it doesn't work, you need to plan what your next entry is. So I would go out on the chart and go back a bit and say, right, so oops, that is where we were. Yeah, we couldn't see what was happening after that. So I would say I'm going to place a limit order there, or I'm going to wait for the price to get there. So I used to set alerts in the chart at that point, and then basically wait for a reversal alert to happen, or wait for some price action to happen around the area to take my short trade. And then the plan would be entry here for whatever reason, using whatever order type I want. And then my target would be the opposite support or resistance that I could see on the chart. So this is an obvious low. You've got a little bit of a low there. That's probably about it. So that area there and that area there, I would say, is probably a decent support area to the downside. So put a little block on the chart. You can see this is a very, very reactive area here. Multiple times we've reacted at those areas. So if I'm going short here and we are in a range, I'm assuming that we're going to stay in the range. You have to assume that the same thing that has been happening is going to continue. The plan is, if it doesn't, what will I do? So there's my target to the downside. My backup is here. And my backup is here. Yeah, so I'll draw those lines on. You can test this with a position trader EA, which we'll look at in a minute. So those are your upside resistances. Yeah, so it's very, very, very simple. So we're not using any indicators at all here. But what we do need to do is make sure that we're not going to get in too big and get in too close together. So you want your support resistance areas to not be, you know, you don't want one there, one there, one there, one there, and then one up there. You want them fairly decent distances apart. And there's no right or wrong way of doing this. It's just, where are the points it's going to react at? Because we know that price moves from level to level. That's all it does. If it's going to go up, it is going to go to there or there. Fact. One of those two is going to get hit. When it's going down, it is going to go to there. And if it breaks that level, it's going to go to there or here or here or here or here. Yeah, something down there is going to get hit. So you know, you can see on the chart where price is going to react, because price always bounce at previous price points. It's got a memory. And the reason the memory is there is because this is where the banks are placing their orders. The banks will continue to place orders at one of these levels as long as there is nothing fundamental that is going to change their minds. Yeah. So my plan right now is I'm going to sell when we get there. The trade is either going to work out and it's going to come down to here. And if it doesn't work out, it's going to go up to there. So I will sell it again there. My average will be there, and I will look for an exit at some point. And obviously, as price unfolds, you will see levels appearing where you would want to place your exits. If it doesn't bounce enough off of that level and it continues to go up, that is where I'm going to place my next order. But I'm going to ignore this area because it's clean air. There's nothing really there that would say the market should bounce at this point. So instead of using ADR distance and trying to space our orders apart a specific amount, half an ADR, 3/4 of an ADR, we're ignoring that. And we're saying we're going to get in, and we're going to get in again at the next point that price is going to turn at, because we're not using indicators. We can't use ADR. ADR is an indicator. We can't use RSI. It's an indicator. We're doing this blind using pure price action, pure support resistance zones that the banks and institutions have looked at. So we'll go forward and see how this pans out. So there's my entry, short. So I've got in short there. That's the price. Price has mucked about for a week up to the next level. So that's my second entry. Price has now pulled down to my first entry, out, done. Yeah. But the reason that happened was that. So all we're doing is we're identifying the points at which price will bounce. Now, if price breaks above that level, and I don't know if it does because I can't remember what was on the chart before, but if it does, this is where it's going to head because there's nothing there to stop it. It's what we call clear air. Yeah, it's a area where there is no reason to trade. It's what they call price discovery. Yeah, we went through this in the second week when I started the member streams. How the market moves. Remember, we use moving balance because there is equilibrium. There is enough reason for the market to hold a price. When there isn't, the market will not be able to get its orders filled and it will go into price discovery to find the next area where there is an area of equilibrium. Yeah, a load of orders basically. So if you're selling and you need buyers and the next batch of buyers is here, this is where price is going. This is exactly what you see on the chart there. So that's basically how the market works. So here you had the opportunity to get out of that trade there because your average price was moved up and you're out, done. And if you didn't get out there, it continued going down. So you would have got out anyway. But there we go. Right. So now price has broken back above that level. So this trade is over. Yeah, we've got in and we've either got out here or you got out there. But I mean, if you didn't get out there, there's something wrong. Yeah, there's a load of money here. Take the money, wait for the next opportunity. So basically now market's moving up. There we go. So that would have been the next short. Now this is the difference between limit orders and don't know what you call it, power orders or confirmation orders. I've just introduced into the EA the sell limit and buy limit buttons because people were asking for them, because people are trading strategies that use limit orders. Yeah, and I understand that. The problem with limit orders is when the market gets to a level that was a previous resistance and the market conditions are different, i.e. the sellers here have made all their money, they are out of their sells, and there is absolutely no reason for them to sell at that level. Price is not going to respect that. It's just going to blow straight through it. So when you place an order at a very old level, price has got more likelihood of flying through it. So you're always going to find that the most recent support resistance levels are going to be stronger because this is the most recent price action. And there's a chance that the banks and institutions are still in the positions that they were in when you get back to those levels. This one here is going back to April, whatever year we're in, April 2022. We are now in December 2023. It's done. Yeah. So, however, it is an area and sometimes price does react there, but this is going to be much, much weaker. Okay. So let's say we took the short there. We've now got to plan the next trade and I can't look back far enough to find any resistance to the upside. So what we would need to do in this case is kind of go out to a higher time frame and find a better level. So I've got to find the level that I would have traded at first, haven't I? Oh, now I'm going to get, where on earth was I? April 2000, I'm back to 2018. Here we are. So that is where we took the trade from. So that line there. So let's go back further. So we've got a couple of levels back here. There's that little one there which was reactive a couple of times. We've got a level there which was reactive a couple of times. We've got that high somewhere around there, isn't it? Yeah. So we've drawn the top 3 lines on there at areas where we've reacted multiple times. We then slammed through it, reacted, 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 reacted. So that's not a bad level. We've got a level there which reacted at a couple of times. There's a bit of a zone up there, so you could extend it a little bit to intake that in. So there's a rough area there where we had price reacting. And then we're moving up into this area here where we've reacted a few times, but you could also pick that high. So it's kind of a zone, draw a zone in. Say from there to there and go along. That would be one decent zone. We got another zone you could draw in somewhere around there. Yeah, and then we got that line there. So moving forward, I'm not going to be able to extend those zones across. That's annoying. Now I've got to go to the daily chart really. So let's. We're up to date, aren't we? Oh, we didn't get to those top 3 lines because basically that was the area we were looking at trading, wasn't it? And it just collapsed from it. So there you go. You would have made money on that trade anyway. But you get the point, right? So that's basically all I was doing before, was just drawing zones out. So if you grab any chart, go to the 4-hour time frame and bring it up to date. What I would be doing in this case here is saying, right, I am going to, and this is how you plan the trade out. I am going to go long from there, and I am going to go short from there. Yeah, because these are the most recent. So always start with the most recent zones of the range, and assume, remember, 80% of the time we spend range bound or in some kind of equilibrium. It's never going to be exact. Yeah, the ranges are never like that. Everybody draws, whenever you see a diagram for a range, it's that, isn't it? Yeah. I don't know. Probably once or twice in my lifetime, I've seen a range that looks like that. That's not a range. A range is this. That's a range. Yeah. It's not exact. It's totally random. Yeah. So this is a range. That's a range. This is all part of this range, this stuff. Yeah. So the range goes from there to there as the upside, and the downside of the range goes from there, probably there, something like that. Yeah. So you're looking for roughly where the range is, something like that. But pick the most recent area because it's reacted there 3 times, that rough price point. So if it pushes up to there, I'm going to short it. If it doesn't work out, I'm going to short it again there. If that doesn't work out, I'm going to short it again there. That doesn't work out. Somewhere up here, I'm going to take another short. But if you look at the distances between the trades, these two are fairly close together because it's a quick in out on market movement. Then we're going to have to go a bit further. So our average is going to not be equal. It's going to be somewhere. So the average would move to there. Then as that one comes in, the average will probably move to somewhere around about there. Then if that one doesn't work out, we're going to take another trade up there, and your average is going to move up to something like that, maybe between those trades. And then obviously you got another one there. But the distancing between them is nothing to do with ADR. The distance in between them is where are the bounce points, because this area of equilibrium is of price discovery is unlikely to provide any support and resistance. So if you take another ADR, another reversal, because you've had a moving average cross or you've had a reversal alert somewhere in there, it's just part of market structure moving up. So there's actually not much point in getting in there. Yes, it keeps the average closer, but you're better off going at one of these levels because the reaction is going to be much larger. Yeah. So that is exactly how I would plan this trade out now. We haven't got obviously any forward data to look at, but does that make sense? So it's just a way of using the buttons basically. So you can put the, and we'll do this in the back tester, but it's just a case of taking trades at support resistance areas and just letting them play out. But you do also want to space your trades a decent amount. So I would still be aware of ADR in the fact that but you can see it on the chart. You can see roughly how far price is moving. So if on average, these are days. Yeah, so if on average price is moving something like that, you wouldn't take 3 trades in one day. One of the other things that I used to do when I was trading completely manually is this strategy I moved over to was a daily strategy. So I was trading the 4-hour charts and the hourly charts, but I was only looking at them when I got finished work for the day. Yeah. So it was a case of I would only really check the charts in the morning and I would check the charts in the afternoon. The likelihood of you having moved and blown through 2 areas of support and resistance in one day is so remote. And if it is happening, you are way too close together with your entries. Yeah. So there, for example, if we get to there and I take a short, I would need that in place as well, because if we get an above average ADR day, there's a likelihood I might want to trigger those 2 trades. The next one is all the way up there. It's going to take a pretty big day to get 3 trades triggered in a day, isn't it? So it's no different to using the ADR distance for scaling in, except we're picking logical price points rather than just distance. Yeah, because distance is irrelevant. And this is the reason I switched over from just using limit orders to using market reversal alerts, because in this move here, you won't find there will have been a market reversal alert in there, because it's just parabolic price action. Yeah. So if I had a limit order placed, I would be in again. I don't want to be in again. Yeah. So that's why I switched over to using price confirmation, using market reversal alerts, or with a position trader EA using a moving average cross. It's both the same thing. You're looking for price to move in your direction before you enter that trade. Limit orders are dangerous because with the Canadian dollar today, let's look at a CAD pair, Aussie CAD. Didn't really move that much, did it? But yeah, if you had, for example, an order sitting there, it just blew straight through it. There's absolutely no reason for you to short that. There was no price action at any point there. We've had green candle followed by a green candle, followed by a green candle, followed by a green candle. Why would you get in short? Wait for price action to show you. Wait for that to happen. Now get in short. And inside this hourly candlestick or 4-hourly candlestick on the 15-minute chart or the 5-minute chart, you have had either a reversal alert or a moving average cross happen within that candlestick. Reason to get in. Don't get in just because it's got to a point. And why is it turning at this point? Because that's what it did the last 2 times. Yeah. That's why we short it at that area. And the area is going to be completely rough, random. You're never going to know where it's going to turn. But somewhere around here, they're selling it. And if they're not selling it there, they were selling it back there. Very easy to plan trade. Get in, doesn't work out. Let's pick somewhere up here to get in again. But I would rather wait for reversals. So using the position trader, EA, what you can do is using ADR. Have I got an ADR? What's the best ADR indicator to use? Just trying to probably... reverse indicator, that'll do. So we can see that ADR is 47 and 23 is half. Harold, got to shoot. Okay, gap fill complete on Euro US dollar. Well done. Not gonna look at that now. You can catch up on the rest on replay, obviously. So yeah, looking at ADR basically is going to tell you roughly, how far apart you want to space your trades. You don't want to get in too close, basically. So 47 is ADR on this. So I would look at this as an entry here. And if that didn't happen, I would be measuring roughly from where I've got in up to that point, which is about 32 pips. And I'd be saying, yeah, okay, well, 47 is an ADR, 32, we'll take one there. But I could say I'll wait until I get to there, which is 44. But if we get up to there, it's 57. So you've got there a range between that high and that high of roughly 26 pips, which is half an ADR. So if you get in here and you get in either here or here, that spacing is absolutely fine. And if that doesn't work out, we're just going to go back further and look for the next one. So in here, say that didn't happen. We don't know it's happened. Somewhere around here, we would expect price to have some kind of reaction, whether it be that or whether it be that, doesn't matter, because we're just looking for a pullback, aren't we, on our two positions, because our average is moving up. So we're going to get in there. And if that doesn't work out, somewhere there. So when you get an accumulation, somewhere at the high or the low of that accumulation is where you'll get the reaction. So if they're going to hold this area, they're either going to resell it somewhere there, or they're going to resell it at the highs. So first entry, second entry somewhere in there, third entry somewhere in there. So you're looking for some kind of market structure pullback on that entire thing from those areas. Yeah. So what you can do with the position trader EA specifically is you can take a trade short with the button, and then you can look at ADR and go, okay, this is roughly half an ADR away. So I am going to say if the market moves half an ADR or more and we get a signal to short, enter me again. And then you can adjust that distance to, that's 97.59. So if, for example, you get in short there, say to the position trader EA, I want to get in half an ADR apart. If it pushes up to there and takes a second trade, you can go, right, excellent, I'm in two. Now the distance between that trade and that trade is 88. So you would set the position trader EA not to use half an ADR, but to use something like 1 ADR, which is 47. So you can dynamically adjust the distance that you want the EA to take the trades at based on how far away the next resistance zone is. So rather than it getting in here, 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 and here, it would get in here, here, and here, because the likelihood of price action happening here isn't much anyway. It's likely to blow through. So what you're going to do is you're going to take extra drawdown by getting into that trade, which is why I don't like limit orders as much. Yeah, because I'd rather have price action confirm things are going to move in my direction. Yeah. So if a position trader EA, easiest way to do this is just to just pick a pair. Let's go with the pound CAD. And literally go onto the hourly chart or the 4 hourly chart, and don't let me stick the ADR on there as well. I don't really want to get skewed by the ADR indicator, so I'm not actually going to use it. So zoom out. Let me just slow that down a minute. And I'm going to basically take a trade either up here, or actually I'm going to buy it right now here because we're at support. Yeah, so I'm just going to buy it here. I can't scroll out because I can't see how far back the next area of support is, unfortunately, because that is the start of the chart. So I'm just going to have to rely on this one, on me just scaling in. Yeah, so we'll continue from here. And the idea of this exercise is for you to, once we get back into this price action, is to not take trades based on distance. So the EA is set to not scale in. Actually, it is set to scale in. Sorry, let me just quickly turn that off. So the way you do that is the distance between trades. We'd set that at, I don't know, 10 or something. So basically we're saying, don't get me in again unless it's moved 10 ADR. It's not going to move 10 ADR, is it? Yeah, so it means we're going to be able to take manual trades. I wonder if I should do this on control points just to speed it up a bit. I don't want it to go too fast. That's the thing. Yeah, it doesn't affect it. No, I'm going to have to do it on tick. And then I can adjust the speed with the buttons. So we'll take that long trade. Take it here. Oh, actually, we'll wait. See, it's already bounced. I've missed it. So I probably wouldn't take it, but I'll take it anyway. So we'll wait for price to either get us out of this trade by pushing up or push down so I can take a second entry. At the moment, it's range bound, so there's nothing to do. We're just waiting and waiting This is the trouble with doing things random live, because it could take forever. Let's just get out of that one there. Okay, so next entry short, that looks like a good little area there to go short. So we'll wait and see if it gets up to there. No, it's come back down again, so I'm going to buy it again down the lows, because that's where we bought it from 1, 2, 3, 4 times. Now it's collapsed. So we're out of the lows. I'm assuming I might have found some support. Trouble is, in the back tester, I didn't think about this, but you can't see that far back, can you? So anyway, I'll get out of that one because we've made $100 odd. So next area I'm going to look at is taking a trade either there or there. So we'll short there. Now, this is the trouble with limit orders. If you'd have placed a limit order there, you've just blown straight through it, haven't you? But my next area I'm going to be looking at, let me just slow this down. From here, yeah, we've got an accumulation there. We've got this area here, not really anything that ties up there for me. So we've got an area there, but really that in this area here, these lows, and that area there is really what I'd look at. So you got this support, previous resistance, it's an old accumulation, and you've got the high. Yep. So if we get to there, second short, there, third short. Speed it up a bit. Speed it up a lot. See how trading is about patience, waiting. Yeah. 3 days now, we've gone nowhere. This is what it's about. This is why people overtrade and get killed all the time, because they're wanting to make money constantly. You can't force the market. Get in everything, get in as much as you can, and wait for some of it to play out. The stuff doesn't play out, you deal with it. Otherwise, you're just going to be sitting there trying to get it right all the time. So this is in profit. It got down to about $30 odd in profit. Also, that may have been an area, enough money to take, but that would be the target really for me to the downside, waiting for it to get down to here. Yeah, because it's either going to bounce at support on its way down there, or it's going to go up and bounce at resistance, isn't it? So there we go. So that's support hit, out. Next trade is going to be taken down here. Also, that's a decent area, look. Lots of reactions there. So I'll try along there, second entry there. Upside, bit difficult to pick an area, isn't it? So that's the high, but that is a little bit more reactive. Again, this is all incredibly rough, incredibly discretionary, but it doesn't matter. And this is the important thing to take away. It doesn't matter if it doesn't work, because if it doesn't work, we're going to get in again. If it doesn't work, we're going to get in again, because the market's just going to continue to go up and down all the time, isn't it? So let's play this one forward and see if we can get in on one of these lows down here. Okay, so we'll buy it there. So for me, target on this one, I would probably look at that as a target. And obviously the next area that I'm going to get into a short would be my exit potentially. So I'm either going to get out here, or I'm going to get out here. So we'll see where we go. And again, that decision-making process is going to be based on how your day, your week, month, and everything is going. So sitting around for a day. Yeah, so that didn't hold. So this area here they bought from doesn't look like that's going to hold. So this is the next area we're going to get a reaction at. Didn't quite get to it. So again, accuracy. It has bounced at support. So that is a support bounce, but it's not at that price point. So this is why when I say about drawing support and resistance, it's always a good idea to put a zone around the actual low point, because price does not react to the pip often. It reacts sometimes to the pip, but most of the time it reacts at the area. So that is a reaction at the area. So there's no right or wrong for this either. It's discretionary. But that there is, what's ADR? ADR is 121. So this is around about it's less than a quarter of an ADR. So I was going to say somewhere around about a quarter of an ADR either side of an area is not a bad measurement for a zone. Yeah, so that is around about half an ADR in total around the zone. So we're looking for it to bounce somewhere around there. That would have encompassed that, but I didn't take that one. So we'll leave it because I didn't take it. So we'll see what happens, see how it plays out from here. So it's either going to pop down now below that level. And let me take the ADR indicator off because that will slow everything down. Oh, now it's going to crash. Brilliant. Brilliant. Okay, so strategy tester doesn't like you adding and removing indicators while it's running. Apparently, that's going to crash. Well, it has crashed because I can't do anything. Spinning wheel of death. I think I'll do that. I'll just shut it. El reboot. Not running for the highs, are they, on the CAD? Hedged on the FTSE, clean break on the DAX today. Very gappy at the moment. Right, so let me just restart that test on another instrument. Oh my God, it's reset everything. Let me just change that to 10 because I don't want it to get me in. Okay, so just start another test. This is Aussie US this time. But this is kind of what I want you to do is go in. If you want to trade this way, obviously the standard RSI, and obviously people are trading position trading in any with lots of different entries. Like I keep saying, the entry is not important. Why you get into your trade is irrelevant. Yeah, because the market doesn't care about you, and it doesn't know you exist really. So we've got a lovely area of support resistance somewhere up here. It keeps reacting. We've got an area down here it keeps reacting at. So sit on your hands, wait for it to get down to one of those areas. This is a 5-minute time frame I'm doing this on, but principle is going to be the same on the 5-minute time frame. Right, it's blown through that. So again, limit order. If you had a limit order set anywhere in here, you are long now. Why are you long? No reason, because there's not been one buyer in the last half an hour in this market. This is, again, I've said a number of times why I've not had limit orders placed in the EA. That's why, because you're just going to get in long, aren't you? For no reason whatsoever. But we'll play devil's advocate. There we go. So that did bounce. But this is now part of this support zone. Yeah, so this support zone is now that big. It was that big. It's now grown. That's all. Now it's gone long. There, I had an opportunity to go short. This is why I can't do it on the 5-minute time frame because it's way too fast. But that short there, I would have taken. It wouldn't have worked out. That would have been my second entry short. The average would have gone in there. So let's see if it bounces there and comes down. That would be the plan that I would have put in place. No. So let's go out. I bet we're not going to have any. 5 minutes, just not right time frame to do this on. 5-minute time frame, you are going to get into way too many trades intraday, which is why I say this is something you want to do in the hourly. Let me just go back to a normal time frame. Go back to the 4 time frame. We can actually trade with money and actually make money on. So here, for example, we're looking at we've obviously got that area there, and we've got an area that's not the greatest, but it's not bad. We've got an area here, markets reacted at. a couple of times, accumulated around it, bounced, and then obviously we've got the high. So those are the areas I'd be looking at and sitting on my hands until we got to one of those. So somewhere around those areas. So we'll take a short up the highs when we get there. There we go. Let's short that. Oh, use a sell stop on a sell market. I'm going to take 2 trades now. Never mind. No matter. So we're in short. We've TP'd. Oh, I've got to take profit set. Oh, well. Doesn't matter. But that, I was going to say, I probably would have gone for somewhere around here as a target because there's a nice little support. And it's blown straight through it. So we'll get ready to buy at the lows. Buy it down there. We've got TP set on, so we're just going to make money automatically. But you get the point. Yeah, we didn't make money because of the TP. We made money because of the whole thing. You know, the fact that it's bounced at that area. The reason it bounced at that area is because that's what it did last time. It's just repeating itself over and over again. I'm going to take another trade at that level if it gets down there. If not, I'm going to wait for it to get back up again. Yep. And what's going to happen as price unfolds is it's going to make new zones. Yeah, so I've now got another zone I'm interested in. Somewhere around there, because this is an area they bought from. It slammed through it. They then sold that area. They sold that area again. They had trouble getting through it. They got through it and then they bought it again. It came back through. Then they sold it again. This is a very strong, what we call turncoat resistance or turncoat support, which is basically an area that has been used for both longs and shorts. Supply and demand. Yeah, same thing. This is an area we've sold at in the past. We previously bought at it and sold at it. Yeah, this is an area we've sold at in the past. We've also bought at it and sold at it. Yeah, this area we've only sold at. This area we've now bought at twice, possibly 3 times if you class this. So this is all you're going to do is every time you see a turning point, you look at that turning point and you go, is it something important? Has something happened here before? But again, discretionary. I've just drawn a blue box there. It could be there, it could be that. You could draw it wherever you like, doesn't matter. But it's an area. You just need to look at areas. And if you just do this with position trading, it will work. So it's exactly the same as I do day by day. The entry for me is RSI or ADR. The entry could also be just literally support and resistance. So this is the whole point of this session, is to just demonstrate how the market moves up and down constantly using extreme moves and then profit takes on it. And it will always go from zones rather than, or areas rather than an indicator. The indicator is showing you what has happened previously in price. It's got nothing to do with future price movement. We've blown through that level. So again, limit orders would have triggered. I'm going to buy it anyway because this is probably the new low on this bit now, and we've just moved the zone down, and I'll wait for it to come up to this area. If it doesn't, there's nothing to the left. I can't really look at anything, so I'm just going to use rough distancing on what it's doing in the day to try and scale in and get out at some point. But it's not really doing anything. This is 4-hour charts, okay? So we're seeing each of these. These are weeks flying by. Yeah, so long-term, weeks going past at the moment. So we've broken out of that low. So I'm going to take another one down here and assume that this is a false breakout of this level. And now we're going to push back up into here, which will give me an exit. If we don't, the trouble is I've got no support and resistance to look at now because I can't switch out to the daily time frame. But if I was trading live, I'd be looking now up one time frame to look at a very old area, because you and I are the same as the market. I'm just going to close that out because it's profit. We're the same as the market in the fact that we also will be looking at the same levels. Yeah, the market, the banks and institutions will be looking at, okay, we're in free fall at the moment. Where was the last area that we had buying? They will be buying at that area because that is the last area there's buying. The market has to have a turning point, and there has to be a place that they want to turn from as well. They will also look at these old areas. the difference in price action when you get to them is going to be vast. Yeah, if you look at an area which is 2 years old, what is like Trump, right? Right now we got Trump, then we had Biden. It's totally different. Everything's different, but it will react at those levels. Yeah, so price has a memory. So right now, there's not a bad little area there. So you could try a trade at that level, but I'd much rather trade at that level because it's a big peak. So we'll have a look and see what happens with price. So that's the trade idea right now. If you want to take this close one, you short it there. And if that doesn't work, you short it higher. So let's say we're going to take that one, right? Next trade is going to be up here. Or it's just going to work. And there's an argument for saying you would have been out on that drop. Yeah, it dropped for a day. You may well have been out on that. Depends what your targets are. Yeah, but again, it's all discretionary. Everything in trading is discretionary. And when you're using areas and not indicators, there is only discretion because an indicator is telling you what to do. If you haven't got an indicator, you are the only person telling you what to do. Shorting it again up there because we're in that zone. So yeah, you become the indicator by drawing on the chart. There you go, TP hit. I mean, this is, I don't know what this is set up for. I think this is probably set up for 1 ADR as a target or double the risk or something. But whatever it is, it's more than we are risking, basically. So, you know, it's just playing out. Isn't it? So this area here is still good. Yeah, like it. We've now got this area down here as well. So somewhere around there, we'd be looking for a trade. This area here is also very good, look. Oh, don't want to do that. So this area here that we identified previously, if we drag this along now. Yeah. Oh, I've just accidentally pressed buttons. It's still reacting here, look. Still reacting. This original zone that we found where we took that first trade from, it reacted again, it reacted again, we pushed through it, it reacted again, and we pushed through it, it reacted again. Buy it. Yeah. And then we know it's reacting up here because it's been doing it loads and loads and loads of times. And this is the market staying range bound. Yeah. We're not trending here. So people will be looking at this and saying we're in a downtrend. Technically, we were until we got to here, but right now I'm thinking we're going into a range. Yeah, but you see how it works. Position trading works. Even in trends, it works in ranges. The only time it doesn't work is in parabolic moves. But in a parabolic move, if you are scaling in at set distances or rough variations of set distances based on price action. So again, with the position trader or the market reverse alert CA, we're saying get me in, wait a minimum of 3/4 on ADR, half an ADR, whatever. If there's no price action that says buy for 1.5 ADR, our spacing will be 1.5 ADR apart. But if you use support resistance zones, your distancing is set by where the market is going, not by a calculation based on maths on average movement. Yeah, so we can see much clearer where the market is moving and turning rather than just using a measurement of distance. Just let this one play out. I've got a buy and a limit. I'm just going to close those out because I didn't mean to take those trades. See, limit order buttons are dangerous. You accidentally press them. I'm going to try a trade up there. I'm going to try a trade out here. If we get there. If we don't go anywhere, there we go. So sell it up there. That was a news event. Didn't work out. So it's our next area up there. And we'll be watching this for a target to the downside. I pressed that button again by accident. Oh, it got me out at target. You know, got TP set. So, but I would have waited until there. So that would have been my short. So I'm going to long it. I've sold it. Cancel. Buy. Yeah. So I'm going to buy it out of this area because this is what we're doing. We're reacting out of this area and we're reacting out of this area at the moment. So as long as we are doing this, you keep doing it until the market proves you wrong, because this is what's happening, and assume that this is going to continue to happen until it doesn't. When it doesn't, you're in a position trade. If it does, you're just in and out constantly. Yeah. So again, buy it down here. A bit late on that one. And I have got this automated TP set, so it's a bit annoying because it's not letting the trades play out to target. But anyway, you get the point. It works. So there we go. So this one's not working. So we're going to need to take a second entry. But we've been trading for, what, 2-3 months here? We haven't lost, have we? We haven't got a parabolic trend, though. So just waiting for price to get down to this level. This is on top speed as well. So I can buy it again, because this is where we bought it last time. So we'll buy it down here. So our average price is somewhere around about there. I haven't got any support I can go to after this one, but obviously we would be going out to daily, having a look where the next support is, but it's in profit. It's done anyway. So, so now, let me just stop this. I've got a very well established downside. Now my upside, we could sell it again out of this area, but this area is getting a bit old now. So I would be more interested in, I mean, in fact, at the moment, I think really I'd be looking for price to get up there. There's an argument for also looking at, not very good, but looking at maybe that area there. Yeah, so trying to keep the support resistance as recent as possible, yeah. So we'll let that play out to one of those zones. So it's either going to get up to there, or go down there. We know this. This is the thing about position trading. You know where it's going. It's going up or down. I'm going to buy it because it went down, right? You know where it's going. But what we don't know is when it's going to get somewhere or if it's going to work. But you can plan, and this is what it's all about. Position trading is about planning. We are planning to buy this low. If it doesn't work, we are planning to do X. The X is the next entry. I can't zoom out far enough, but below here, an old support will be looming somewhere that we will want to get into. Now that is also an important point, because if you see an area like this and you don't see another support for 3 or 4 ADR, that's probably not a good one to take. I'd be much more reluctant to take something which is an all-time low or a yearly low or a 6-month low than I would another trade which is inside of some price action. Just buy it again because we've moved. But if you're trading something within price action, i.e. you've got a defined high and a defined low and you're somewhere in here, you've got so many levels to bounce off of. It's highly likely to work. And if it suddenly goes parabolic, it's going to find an area which it's going to react at, which is very, very an old defining level of a previous range, a range high or a range low, rather than an intermediate level. So this one, we've got a nice move out. We're selling off for 3 weeks here. So, and again, trading in line with swaps with this method and normal position trading is much more prevalent now, isn't it? So that's pushing up from an existing area. I don't know because I made it up, but it's an area basically somewhere around here. But this is the only problem with a back tester. Obviously, you can't go back too far. In fact, you could do. I'll show you in a sec. I'll just wait for this trade to play out. Kind of need a cancel limit orders button, don't we? Also nice to be able to move these, but you can't. So just waiting now. We can see we're definitely forming a low here. We've got a market structure reversal to the upside and a retest. So this looks like it's probably going to bounce. Where's it going to bounce to? Yeah. So there's your TP. It's going to sit there now for 6 weeks, isn't it? And do absolutely nothing. Can we try it with recent US dollar CAD trend on H4? Yep. Yeah, so I'll show you how to get older data if you're using Tick Data Suite in a sec when this plays out. Need another level, don't I? And the lovely thing about doing this on the 4-hour time frame is that I've got 4 trades on in 3 weeks. So when you're whatever time frame you're trading on with this style of trading, it's much better to just let today play out when you take a trade and not try and take another intraday trade. The problem people have with trading is with position trading a lot of the time is they try and take trades too close together because they get impatient. This is a 4-hour time frame. So if you just take a trade, these are going to be weekly support resistance levels you're going to see in here on monthly levels. So you're not going to be able to take 2 or 3 trades a day on a 4-hour time frame. You're going to get into one because the next zone is going to take days to get to. With hourly time frames, it's going to take many hours to get to the next zone. So you're likely to take 1, maybe 2 trades a day, if that. So you're not going to get into many positions, many trades within a position most of the time. We've got this area forming here now, which is a problem because it's possibly going to act as upside resistance. But we'll see what happens. It's taking a while to play out, obviously. Let's try it on the US dollar CAD from October. Yeah, in a parabolic trend, you're probably going to find it very difficult. You're going to take a loss. This is not going to get us out of losses. You're still going to take losses. Yeah. So depending on how my position, portfolio, week, month, and everything's going, I'm only in 4 on this at the moment, so I'm not in a squeeze. It's just in drawdown. But yeah, I mean, if you go into a parabolic squeeze, you're still going to need to take losses. But we'll look at how that would have played out, that US dollar CAD squeeze, and where the entries would have been. I'm going to fall asleep waiting for this to play out. Let me just quickly look at the indices. Oh, rotation. Look, we've got gaps, rotations. It's just horrible at the minute, indices. Not playing ball. There we go. So that's in 200 odd profit. Take it. Out. Done. Right, let's try that. So the other thing with Tick Data Suite, when you're using tick every tick, yeah, what you basically can do is if you go into advanced, you've got bars before data. So whatever dates you set as your start date, you can go back a number of bars. So I'm going to set this instead of to 1500 to, I'm just going to put a note on it, 10,000. I'm going to do 10 times as much, yeah, data. So it's going to load that number of bars before we start our test, yeah. So let's go to US dollar CAD. What data have I got up to? 6th of November I've got to. So that's up to the election, isn't it? And covering the election, so that's okay. Let's go to the let's go to the 5th of November. So we'll start October 2024. 10, start at the beginning of October. When did the squeeze? Yeah, so I mean, you'd have shorted there, wouldn't you? So we need to go back to September. Let's just pick the 1st of September. Actually, no, let's pick the 20th. 20th. Oh. Why can't I type 20? 20th of September. Okay. Right. So we do not know what's going to happen. So got an area there. You've got an obvious area here. And obviously we got this high. I mean, it's a little bit difficult to do this because I know what's coming. But the zones I can see here are, let's draw loads in. Why can't I click on that? There we go. You got that area there as well. So that's what I see initially from where I am right now. And obviously we see a low down here, which is going back to here. So it's this low, bounced out again. And we've got a low here and a high area there. So this area here we bought at loads of times. We also sold at that loads of times. Yeah, so this is a nice support resistance. Now, where we are now, and again, this is going to depend on where we are, because what trades we're in as to what's going to happen. So I am going to not take any longs. I'm only going to take shorts, obviously. So we'll let that one play out. So I'm going to look to short it in a minute. So I would have bought that. We'll be out. We got that TP set, haven't we? See, this is going to get us out in profit from a short, probably, possibly. I don't know. We'll wait and see what happens. Yeah. So I'm going to sell it somewhere around about here because it's the obvious spot. That's a high, so we know we're going to get a reaction somewhere around this zone. So the recent zone, this is a really old good zone, so we'll sell it there. So that's a good area to sell at. The next area I'm going to sell at is going to be at the next resistance, which for me is there. So this low here is that accumulation. We got that accumulation. So you've got two accumulations, one there where you had the lows put in, and then you've got another accumulation there with those lows put in. So somewhere around here, which is this old resistance, is where we reacted at. Yeah? Then we broke through it. So that is a valid support resistance turncoat zone. So you're looking to get in somewhere around about here. Doesn't matter whether you got in there, whether you got in there, you got in there, you got in there. Somewhere here you got a second order on. Yeah? First order was taken out of this zone. But you see, there's nothing to do here. We get in here. I don't know what the distance is here. 140 pips. But the next area is obviously this support resistance zone here. So it's this little low. We bounced that twice, broke through. Yeah. So it's that, which is this area here. Yeah. So that's the next area that you'd be selling at, which we are fast approaching. If I go and speed that up now, I won't get the entry on. Got to get in there quick. Speed up a bit more. I don't want to miss it, that's all. That probably would have been my entry. I missed it. The trouble with the back tester is you're never going to be accurate. But there we go. In. Right. Next area is this high here. Let's speed up. We know we're going to get there. I probably would have taken that. Possibly. I don't know. But it's not going to pull back far enough to get out. Obviously, we know that. Missed it, but close enough. That is our next high. This spike. So 1, 2, 3, 4. We're going to take 5 when we get there. So again, nothing to do until we get there. We're there. So that's a terrible entry. That is not what you'd have taken. 4 or 8 hours. Since we hit that, 8 hours have gone past. Yeah, I'd be up here somewhere, roughly. But it'll do. Okay. Now there's nothing there's nothing left. Why'd you stop? Why did that stop? Fourth of November. Oh, we're out of data. Where was the election? Oh, we haven't got any more data. Anyway, let's look at US dollar CAD. Let's put them side by side. Let me just shut that a minute. Right, so our price, we are in here, 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 there-ish. Okay. So moving forward, it's there, isn't it? That is roughly where we are at the moment, isn't it? Yeah. So that is kind of the equivalent of the chart. So you're going to be in, potentially you're in 1, 2, 3, 4, 5 trades, depending on the lot multiplier. If you're using one, distance between those trades, your average is weighted to the upside. So your average is going to be somewhere in the region of there, I would say, ish. So somewhere in the region of 137,885. So let's say, yeah, somewhere around there. That's your average. Okay. So you're still in it. So the next area of resistance from this high is basically up there, isn't it? But this accumulation here, where we are right now, is the last accumulation before this spike. Now, this spike here obviously is COVID. So this is the COVID high. So the only thing you've got after the COVID high to look at is this accumulation. So this area here is the only thing that you can really use as a potential support resistance zone moving forward. Can I zoom out enough? Yeah. So this is the area. So ignoring the COVID spike, this is the area we accumulated around. That's all you've got to go on now, which is exactly where we are at the moment. So we've broken out of this range high. You're in 5 positions, 6 maybe, and you're still in it. But there's nothing you can do about a parabolic squeeze like this. It's just, you know, there is no exit in position trading in parabolic squeezes like that, apart from to survive it. And this is the whole reason for scaling in small and starting small, is you can survive this. So we can't see into the future, but what we need is that to get out. We need to come back to the election levels to exit. That's where you need to be. That's it. Or you're starting to take losses out. That's all you can do. Yeah. So again, this way of trading is a manual support resistance method of position trading. Position trading is a methodology that you apply to a strategy. It's a way of trading, same as using a stop loss or not. It's just another way of scaling in and scaling out the market. In parabolic moves like this one here, you'd have had exactly the same problem, but you would have been out here. Yeah. So if we look at this move down, let's just delete. So that would have been your long. That definitely would have been a long. That would have been a long. So for me on this one here, this is a tricky one because let's say, for example, we took a long here. Right, this is the same parabolic squeeze as this, basically, pretty much, isn't it? So you'd have got in long there. The next entry really is that or that. So it's either these highs here, or you can take these lows here, which is this blue zone. But there's an area here, and the question is, you have to ask yourself in this sort of movement is, do I want to take this trade out of here, which you would have taken here, or do I want to wait until this? And that is going to give you an average price. So you need to think averages, yeah? So if you're getting in long here, right, you can either take that or you can take this. And this is all hindsight based, yeah? It's not the hard right edge. So you're either going to get in here and make your average there, or you're going to get in here and make your average there. Yeah, but as you move down to here, your average is going to jump down to there anyway, because you've got one trade there, one trade there, one trade there, giving you an average roughly there. So the question is, do I take that one and that one, or do I slot one in the middle? By the time you get down to here, the outcome is the same. You've got an average price in roughly the same spot, but you've got more drawdown because you've got an extra drawdown there. That's the difference. That's the only difference. So you definitely got in there. You'd have got in there. So you've got that space there. You may have taken a third. The next level of support on this to the downside after this is this massive area of chop. So you've got choices of, I mean, there's an area I can see here. Not very good. There's an area I can see here. But knowing me, I would have been scrabbling for an area to get in, and I would have taken one of those. So I would have been in somewhere in here. But look at the parabolic. And again, limit orders, yeah? If you'd have taken, let's just draw those two lines in of those areas. I would have been looking at maybe, it's really hard to pick one, but something like that. Or I would have been looking at something maybe there. I'd be looking at that. And I'd be saying, is there something around about that area? It's not very good at all. But if I was in there and maybe even at there, I would definitely be looking for another one somewhere around here before we got down to here. But look at this parabolic move. Boom. If I'd have placed limit orders there, I would not have taken a trade. I would have taken a trade. This is why limit orders aren't good. If you get a parabolic news event that goes 200 ADR, you are getting into drawdown just because. There's no reason to get into drawdown. There's a parabolic news event going against you. Wait until you get here. So 1, 2, 3, or 4, 5 out. Yeah. This is what we've got now. The inverse of this. Yeah, but it's gone further, isn't it? Yeah, in the real world, it's gone further. So we need to be on the 4 out. Yeah, so that's that parabolic move we just looked at. This is the election, and this is the reason of this. It's because of the election, yeah, and this is why I exited with a loss here, because of the election. And you've got to be astute as a trader and think, holy crap, I am in X drawdown if this goes against me, always think worst case scenario. I don't know if that's the way I always look at it. Worst case scenario. What's the worst thing can happen? It could go beyond because Trump wins. What would happen to me? I would blow my account. I'm shutting it because I don't want to blow my account. I'm not going to hold out on the hope. You can't hope. Yeah. So this doesn't fix that problem. And these are parabolics. You're always going to have the same problem in parabolic. What I'm trying to give you here is an option of something else to do instead of using indicators. Yeah. So same thing. So if you look at any pair that spends, this is a 4 hour, but it spends 90% of its time doing this. But if there's an intervention from Japan and you're the wrong way on it, you're going to get hurt. There's nothing you can do about that. That's just part of trading. Yeah. Everybody gets hurt in this sort of situation. The banks and institutions got hurt. They are sitting here in shock at the moment because they got hurt because the Japanese did that. Yeah. Intelligent banks and institutions would have gone, holy crap, there's a chance of intervention. But we've had so many chances of intervention in the past that haven't worked out. They probably sitting through it and getting hurt. Nothing you can do, is there? Why do I keep getting ADR alerts going on? Oh, it's because it's got the ADR indicator on. That's why. Let me just take that off. So, so yeah, there you go. So that's basically all I wanted to cover today was just going back to basics of position trading and looking at how to use lines, levels, support, resistance, zones, basically instead of indicators. Yeah. So an indicator could give you multiple entries. We stick an RSI or something on the chart. Where are we? RSI. Let's just use a 14. So you see the RSI is going to give you lots and lots of reasons to get in. So selling the high there would have got the same result. Selling the high there, if you'd have done that, you wouldn't have got in with an indicator. Down here, yeah, that low, you wouldn't have got a signal or an indicator to go long, but you do at support resistance. There, no signal. Would have got in on support resistance. There, did get a signal. Brilliant. That long there, maybe would have taken 2, but you'd have got in on that one. So it would have been better to use an indicator in that respect, that particular time. This one, the indicator said to short, you probably would have shorted it there anyway. So no difference. But you see the difference. You're going to get some entries with this that are just reliant on price action bounces with banks and institutions, limit orders triggering, which are just going to play out or not play out. But the difference is irrelevant. Why you get in doesn't make the money. Why you get in, what happens after you get in is what makes you the money. Let me just catch up on the chat. Can we please have a future session on how to deal with continuous trending pairs? Well, we've got videos on that. Aggressive drawdown control or scaling out. Just taking losses. There's no session really on what to do because it's dependent on you and your situation at the time, right? There's people sitting here now, or not necessarily in here, I don't know, but there's people now that are in the US dollar CAD short. I have just made a profit on a long trade on it. Yeah. Because I got out of my US dollar CAD. That was what I did because of the way that my portfolio and account was at the time. So I can't do a session on what to do because what to do is dependent on you, how you're trading, what you're in, where your average is, what news is coming up, what the rest of your portfolio looks like, and what you've banked this month. There's too many variables to say this is what you do. I advised people to get out before the election. If you didn't get out before the election, then you need to deal with the situation that you're in. But I don't know what that situation is. Some people scaled out partial profits, partial losses and held some. They held some through this. They may well be out on that because they may have taken an aggressive drawdown control position there, and that would have given them an exit, a break even on the rest of their trade. But it's impossible for me to do a session on what to do because I can give you what you can do, but what you do is up to you. There is no best case. There's no best thing to do. The best thing is to get out without blowing your account. Lessons to be learnt are always the same. So if you are in 30% of drawdown on a single trade, you're not doing drawdown control, or you over leveraged your first trade and the positions beyond it have got too big. Yeah, the reason people get position trading wrong, there's two main reasons. Yeah, the first reason is they get in short at a signal, whatever the signal may be, and they risk 1% of their account or 0.5% of their account over half an ADR or something. Yeah, so you're getting into a squeeze with a very high risk. So when this thing goes against you, yeah, like this initial position here would be something like 10% in drawdown. Add all the other positions in, you're sitting in 30-40% drawdown on one individual instrument. So the first problem to stop having a problem in the first place is to take tiny risk. 0.2% over one ADR or 0.1% over one ADR. Take tiny risk. You're going to make tiny profit, but you're not going to blow your account. You're going to make money. The whole purpose of this is to make money. Yeah. So using small risk. The second thing is spacing. If you get in here, 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 by the time you've got to here, you're in 7 trades. You're in 25 trades up here. So spacing is the second reason people get position trading wrong. It looks like this might go from here, but it's only 0.2 of an ADR beyond your initial position. Yeah, but it looks like it's going to go. I needed it to go down to there. Well, it didn't. It went up to there. Oh, well, I'll just take another one there then. Or I'll take another one. Random. Yeah. Look at what we've just covered in this session. Yeah. If you're going to buy it there on a breakout, for some reason, don't know why you would, but, and it doesn't work out, you could buy it there. And if that doesn't work out, you could buy it here. 3 trades. Yeah, but don't buy it there and then buy it there, and then buy it there and there. And don't buy it because it's moved 1/4 of an ADR or half an ADR. Just because something moves a distance is not a reason to take a trade. This is grid trading. Grid trading does not work. Yeah, there are a lot of grid trading EAs out there you can download demos of. Go and test it for yourself and show yourself that grid trading doesn't work. If you place a grid of orders which are distance apart and that happens, you are in 1, 2, 3, 4, 5, 6, 7, 8 trades in drawdown. Why? Because you told the market to get you into massive drawdown if it pushed really hard. No, get in short, and if it does that, get in short. Or there. Yeah, don't take 5 trades. So spacing. So initial lot size, tiny. Spacing, either decent distance based on the average movement of the instrument, ADR, 3/4, half, 1, something like that. Or, as we've just covered in this session, you get in short there. Let's pretend this didn't happen. Let's pretend it did that. You get in short here. Why? Because it's a logical area. It's a logical place that price has reacted at in the past. There is a probability of a reaction in the future. If there's nothing but clear air between where you've got in and the next level, don't take a trade. It will make your average further apart, possibly. And if it did bounce for no reason, because of a news event, for example, which it will do, fine, you'll get out. But if you don't, and these are, all these things I'm introducing here are variables. And every instrument and every week and every month is repeated never. Yeah. So the price action we're seeing on the US dollar CAD here, and we've seen here, and we've seen here, has never happened in the past. This, from here to here, you will never find this on any instrument, US dollar CAD, or any other instrument in history. So you can't plan for it. It's impossible. You react to what the market is doing by either entering or exiting positions, moving your price. And by exiting a position, you are moving your price. So if you get in short here, you get in short here, you get in short here, yeah? And as this happens and that happens, you think, holy crap, I need out. You get out of that one and your average is now here. Your average was there. So by closing that in loss, you move your average up. Every position you close below the average line moves the average closer to you. Every position you close above the average line moves your average further away. So you always close out from below the average, which brings it closer, which gives you an opportunity to exit. But when you do it is not something that anyone can tell you. It's when you do it. I can tell you it's better to space your trades around about 3/4 of an ADR apart, because it gives you an opportunity for price to move an ADR in your distance, which will give you an exit. I can tell you it's best to get in with a very, very small risk so that if you get into a squeeze, you can survive it, because it will pull back. Occasionally, you'll get something where it won't pull back because of a fundamental shift. Fundamental shifts happen in the future and they are created by news, and you can't see the future. You can't predict fundamental shifts. When a fundamental shift happens, so let's say, for example, the New Zealand decides tomorrow not to change its interest rate by 0.5%. Instead, it decides it's not going to change its interest rate. The New Zealand dollar is going to fly through the roof. Yeah. If I have got shorts on the New Zealand dollar and that happens, my thing is shutting trades, because this thing's probably not going to come back from it for a good couple of months, because the market's been selling into the New Zealand dollar because it knows it's dropping its interest rates. If it decides not to do it, it's going to go parabolic. Get out. But you can't plan for that. You can't see it coming in a back test either. Yeah, this is where your experience and your discretion as a trader comes in, and you have to build that. But the muscle memory you build will be based on what you see over and over again. And the vast majority of the time, this happens and you've got no problems. When that happens, you need to be small enough that you can survive it and wait for the market to come back. Too much size, too close spacing means your survivability is shortened. Your lifespan in a trade is designated by your initial lot size and whether or not you space 0.25, 0.5, 0.75 or 1 ADR apart. Or, as we've covered today, you don't bother with any of that and you space your trades at areas where it's bounced in the past, in which case then you've got a dynamic spacing and a dynamic average. But what's the best to use? No idea. There will be one, and I can backtest an instrument and I can give you a set file to give you a profitable outcome and a beautiful curve on your P&L that is absolutely spot on exactly what you should have done in the past, and I can sell you an EA on that. But in the future, that isn't going to happen, because the exact circumstances that required over this period of time a 0.25 ADR to generate a 5% profit, over the next period, you should have used a 0.37 ADR to produce a 5% profit. Curve it. Can't use any of it. Yeah, it's got to be just get in, wait, see what happens. That's all you have. Yeah, and this is why it's hard to do sessions on drawdown control. And you know, I'm not a financial advisor. I'm a guy that trades. That's it. I have no qualifications in anything to do with finance. I have just observed over decades this thing going up and down. Yeah, and I've identified that the banks and institutions use dollar cost averaging techniques to get in and out of trades. That's what I've identified. And I've identified on the chart and proven to myself that that is what happens the vast majority of the time. This is experience. This is the market kicking you in the arse and saying, every now and again, it ain't going to work. That's when you take your losses. If that happens 2 to 3 months a year, you're a profitable trader. That's it. Yeah. You're never going to have a year. I've never had a year where I've had every single month profitable. Never. Ever. Doesn't happen, because the market conditions at points in time will go nuts because there is a reason to go nuts. If you're in the right way on that, you won't hold it for that. There's nobody that longs the US dollar here that is still in the US dollar. CAD. Yeah. They'd have got scared by that. They'd have got scared by that. And they'd be either out there or there because there's no reason to get out there. So that was a beautiful trade. Well done. But you are not in it here now. Because this was not foreseeable. Nobody mentioned, Trump has never mentioned in the past he's going to put tariffs on the Canadian dollar, on Canadian imports. He did. You can't predict this. So what do? I don't know. I'm not doing anything because I was in a long trade and I made a profit. If you're in a short trade, you have a different decision-making process to make. Have you made 16% profit this month and are you in 8% drawdown on this trade? If so, shut the whole lot. Walk away with 8%. If you've made 2% profit this month and you're in 8% profit, your decision is, of 8% drawdown, do I close the whole lot now and walk away with a 6% loss? Or do I hope it comes down? That's your decision-making process. It's not something I can help with. You can ask 100 people for advice, but one of two things is going to happen here. That or that. Find out next week. Or find out later this afternoon when consumer confidence numbers come out. Or find out this evening when FOMC meeting minutes come out. It's either going to be up there or it's going to be down here. But I can't make a decision for anybody else on what to do in this situation because I've never had that situation. I can tell you what the outcomes are going to be. It's FOMC. It's going to cause one of those two things to happen this evening. That's all I've got. That's all I've got. Oh, I did a Trump then. Did you see that? Don't want to do a Trump. Hope that helps, but I can't. There isn't a rule book for this. Yeah, it's a totally different methodology of trading, which is why it works, because everybody else is short now with a stop there. FOMC is going to do that, and everyone's going to go, they stop run me. No, the market just reacted off of FOMC. There's a load of limit orders that high because that's where it was last exhausted, and now it needs to return to origin because there's nothing wrong with the Canadian move. You can put any framework of theory behind it, but at the end of the day, if you use a stop loss, you will get stopped out. If you use a take profit, you will exit the market too soon. That's the facts. If you just get in and wait and see what the market does, the market will give you an amount of money each month. That is not determined by you, it's determined by the market. But the decisions you make along the way will determine the X result at the end of the month. This is why no one else gets the same result. So, difficult one to answer, really. This is my takeaway. Actually, do not know much. Oh, hang on. So I've missed one. I like your question. Lee did not take many longs for euro or euro pound, and also no strong shorting on the US dollar. He got this understanding from economic news and obviously from Trump, but EAs do not see this yet. It's discretion. You know, this is all these courses, you know, and mine to a certain extent teach you a mechanical trading system, which uses indicators to signal X to do Y. But all a strategy is a indicator signaling a binary decision. The outcome of the trade has nothing to do with the binary decision. Yep. Because this is literally put risk on. Yeah, you determine that. You only have control over risk. When you press these buttons, you are entering a lot size into the market. The lot size is based on the risk that you're going to place. That's the only thing you have control over. You need to relax and let go of expectancy, let go of hope, let go of all emotion in it and just enter. I have a P&L running at the moment. I have no idea what it's doing. But what I'm worried about is stuff that gets big. Anything that doesn't get big just gets banked. Anything that gets really big, you saw in the run up to the election, my focus every day, US dollar CAD. I'm only focused on that because that was the problem. Everything else was just getting banked or was sitting flip-flopping around. And I use that terminology a lot because that's what the market does. all the time. It flip-flops around. We sit around waiting for news. That's it. That's what happens. We sit around waiting for news. Yeah, news. People that call, one of my mentors used to call fundamentals funny mentals. He used to take the mickey out of me all the time because I started looking into fundamental trading and why this thing moves. And he was like, don't fall in with the funny mental crowd. They're stupid. Yeah, they think that trading should be based on the direction of the future of news. And to a certain extent, he's right, isn't he? But he's not right, because that is the only thing that moves this. The reason this moved 225% of ADR today has nothing to do with anything but Trump opening his big mouth. Yeah, you have to pay attention to this, and you have to now change your view and make a decision. The banks and institutions now have guys sitting there, banks of them on desks, being paid 60 to 100 grand a year as analysts to look at the information that has come out and put together a scorecard as to whether or not the traders should be long or short bias on the Canadian dollar today and for the next X. That's what their job is. They get paid 6 figures to do that. That's the same job as you have right now. You now need to analyze, what is the Canadian dollar doing next? If you're in it, you have a decision to make. If you're not in it, you have a decision to make. Do you want to get into it or not? And if you do want to get into it, which way do you want to go? But it's a binary decision. You can't control what happens next. The only thing you can control is, I have no exposure on the US dollar CAD. Do I want any? For me, the decision's made by that. I'm not shorting it because it costs too much. And if it goes like that, I don't want to be in it because it's going to cost me too much money to trade. I was in it there because it doesn't cost much money to trade. My decision-making process was made by this and this. Now, I could have used this as my decision-making process. Yeah, it doesn't matter which of these I use. What matters is it went up, so I made money. That's it. But it's not my control, is it? Hopefully that makes sense. One could have survived US dollar CAD using support and resistance as entries with position. However, if used RSI or MRA, it would have been losses. Yeah. Yeah. But, you know, it's all hindsight. So now if you switch over to support and resistance, Sagar, and you get into a trade and the support and resistance doesn't work for 8 weeks and it goes parabolic, it's exactly the same as if you'd have used an RSI. It's going parabolic. The reason you're losing is not because of the indicator, not because of the technique, not because of the strategy. It's because of the risk. Yeah. If you get in with a 0.01 with a or a 0.02, for example, with a 1.1 multiplier with a position trade at EA, it will never die. Because if you've got a 50 grand account and you're getting in with a 0.02 trade, there will never be a point in time it will ever get to drawdown that will blow your account. Equally, it's never going to make much money, but it will survive everything. It will survive COVID. It will survive Trump. It will survive probably a nuclear war. It won't. No one would. But anyway, you get the point. Yeah. The reason you die or lose is because of the initial risk taken. If the lot size here is too big to start with, the drawdown will be too big. Therefore, your decision-making process on closing trades will be faster. Now, someone else that's taken exactly the same trade, but used half the lot size, won't be making decisions to close trades out because they won't be worried about it. Equally, someone that takes a trade with exactly the same risk, exactly the same level, may have a risk tolerance of 10% on their individual positions, and your risk tolerance is 5%. So you'll start closing out at 5%. And as soon as you do that, the market comes down and the other person makes a fortune. You make a small profit. You both took the same trade with the same indicator at the same level or the same support level or resistance or whatever, but your decision-making process was different. And that's what makes you money, decision-making. Trading is discretionary. There is no automated way of predicting the future. Just doesn't exist. You have to react. There are better ways to do things and there are worse ways to do things. The best way is to scale in small and scale in with decent distance. The worst way is to get in big to start off with and tight trades. Now, if a market was to go like this for 7 months, getting in with high risk and tight trades is exactly the right thing to do. But unless you can predict the 7-month range, you don't know what risk to take or what spacing to use. So this is what backtesting shows us. Backtesting shows us that small risk and wide distancing is better than high risk and small distancing. That's all we can get. That's all we can use. We can say this is probably roughly the best thing to do. And I can put out 100 set files which give you similar results, but with totally different settings. But they're all risk averse. Yeah. Distancing between trades. Yeah. Look at these trades here. The reason that I got out of this US dollar CAD with a lovely profit was because of the spacing. Yeah. Those 5 trades there were all within half an ADR. Yeah. I got in super aggressive. That was my choice. I had a stop loss. Yeah, above the highs. And the reason I got in super aggressive was because that was election week and I needed out. And I was assuming that they would undo some of the move before election week. They did. If they hadn't, I would have taken a much bigger loss. Decision. I can't teach this. No one can teach this. This is me needing to be out of this position. That was it. That's the best I can give you on it. There you go. There's your session, really. I mean, that's it. I can't give you anything concrete. Figure out early that the pair is in a strong trend. You can't figure out what a strong trend is. Again, this is the thing. You're everything that you're saying is very much, and this isn't, I'm not having a go at you about this, Sega. I'm just pointing out everything you're saying is trying to figure out a way to predict future price movement. That isn't possible. Yeah. Even if you go back in time, using the RSI is a great example. Yeah. So I'm going to draw a line on the RSI here. Big, thick line, right? And we're going to go back in time. So this is April 23 until August this year. So May, June, July, August. So this is a year and 3 months roughly. Okay. The highest ever point the RSI got to over that period was there. Yeah. So in the past, before this date in July, if you were trying to predict the future, you would have said this has a strike rate of 100%. Yeah. And, these ones here worked. This one here worked. This one here worked. Yeah. 100% strike rate. Move forward in time, and all of a sudden, you took a trade here. Holy crap. Yeah. Nothing can predict the future. Every time you have something that, and this is something you just get over years of doing it. Every time you find something that works, the market will turn around and go, you know what? It doesn't anymore. Because there isn't anything. There is stuff that is best to do. And using that level I just put on the RSI, which was probably 90. I don't even know what it was, but it was probably 90. 87. So using the 87 RSI, or let's say 85, all of those would have triggered off of 85, was the best thing to do until here. But this is Trump. This is an election. This is a fundamental. So this 85 level on the RSI in the future is still going to have an incredibly high strike rate. But there are things that are going to happen in the future that are just going to mean this is blown out of the water. And this is partly where support and resistance, what we've been covering today, is more beneficial, because there is nothing that we are looking at in the past from an indicator perspective apart from price. Price is our indicator. So when we look at an area like this and this, when it gets there in the future, we sell it. This is the indicator. The indicator is history, but history doesn't predict it, does it? Yeah. So you've got to, I think, Sagar, in your particular case, I think what you need to focus on is the here and the now and the current, and forget about trying to predict the future. It's a very hard thing to undo. It's a kind of a system hopping. You've been around for a long time here. I know you've seen your name pop up a lot. So I know you are here, and it's great. And you've stayed here, which is great. There still isn't anything that I can show you that is going to not make losses. It's not possible. But the system hopping methodology or mentality is created by seeing success and then success failing. And that will always happen because there is nothing that can measure future. Yeah. So, and you know, bare naked traders who trade pure price action are as good, if not better, than anybody that uses indicators, because they are using nothing to predict nothing. Therefore, they have no expectation. When you use an RSI, and RSI gets above there, your expectation is for the RSI to drop. When it doesn't, you lose faith in the RSI, which means you throw the RSI away and you move to the CCI. The CCI does the same thing, but until the CCI has proved itself to be incapable of predicting the future with 100%, you throw that away. Then you move to the MACD, and the MACD will do the same thing. It will give you lots and lots of trades, and you'll think this is brilliant, and then it will prove you wrong, and you'll go, MACD is useless as well. What other oscillators haven't I tried? 2 years later, you'll have gone, oscillators don't work. No. Time machine. That's what you need. It's the only thing you can use to predict the future. So you just have to manage risk. And that is discretion. Trading is all about discretion. All the best traders on the planet have used discretion. Yeah. Larry Williams, RSI2. Amazing strategy for stock markets, specifically the S&P 500. But he didn't take every single trade. Yeah. If there was an RSI2 signal 10 minutes before FOMC, you reckon he took that one? No. He'd be sitting there going, I'll wait until FOMC plays out, because this thing could drop this afternoon or this evening, and I'll wait and see what that is. I'll leave this signal alone and I'll wait for the next RSI signal to the upside. That's what he will be doing, because he's using discretion. And his discretion is only built by watching this happen over periods of years. And this is why I say the backtester is your friend. If you go into the backtester, like we've done this morning, and you press this play button on the 4-hour chart, and if you literally just zone out for half an hour and just sit here and watch this thing go up and down, yeah, this is burning into your retina. You are seeing the same thing happen over and over again. And when the next thing happens, you'll be able to go, I haven't seen this before. And all of a sudden, you won't be expecting something to happen. Yeah. Yeah. I haven't seen a move this big before. Okay, well, this is unprecedented, isn't it? Accept it. Now you have. Now you can tick this one off and know that the thing can move 10 ADR in one direction in 2 months. So I need to plan for that in case it happens again in the future. And what you'll end up with is a strategy that uses tiny risk, because you will find out that there are zero profitable traders out there that use 1% risk per trade. Because unless, if you're using a stop loss with 1% risk per trade, you'll have a lucky run, but then you won't. And you'll end up, like we discovered when we did that testing before, it's a zero-sum game. Using a stop loss and a risk-reward strategy will work when it works. When it doesn't work, you will come back to where you started. At that point, you will go, that's no good, and you will move to the next strategy, or you will tweak your strategy, creating a new strategy. Then you will test that one, which will work for a period of time, or it won't. You'll either scrap it, or you'll wait for it to work, then come back to zero sum, and then you will scrap it, and then you will go in that cycle, and you will be there until you die. Because the only way to make money is to let the market move and change the price according to the market movement, and then wait for the market movement to correct itself. Because if you watch this, that's all it ever does. Historically, this thing has done nothing but go up and down for hundreds of years. We haven't had charting, obviously, for hundreds of years, but we had in the 1930s ticker tapes. And ticker tapes were plotted on pieces of paper. And those pieces of paper created graphs. And graphs went up and down. Support and resistance was created. That's it. Indicators didn't exist. People then started plotting averages on those graphs and thinking, hang on a minute, It's been going up most of the time. So when it comes back down again, we'll assume it's going to continue to go up, and they created trading. It's just what's happened over the period of year. But there's still no one right now, even AI, that can predict the future. That's the bit that everybody has to let go of. And this is what position trading does. It lets go of your predictive power or your need to predict the future. What you need to do is change your entry price to be better than it was when you got in, because when you got in, you were wrong. If you were right, that's fine. Don't worry about it. But if you were wrong, you need to change your price because you don't know where it's going next. Better spacing and lot size is a lesson. Yeah, exactly. Perfect. You know, it's a long-winded thing to do, but get a demo account and either use the position trading EA. But I mean, you can do all this in backtesting. This is what backtesting's for. In the position trader EA, you know, if you set, let's just use an RSI strategy, but do a robustness test, a system parameter permutation test. Yeah. And test an RSI entry strategy. It doesn't matter which one, but set your targets at your spacing at 0.25, or do it at 0.2 or something. 0.2, go in 0.2 increments up to 1.6 or something like that. And with the lot multiplier, go with a 1 in 0.1 increments and go up to 1.5, right? Run those system parameter permutations and also test using 0.1% risk in 0.1 increments up to 1%. Something stupid, right? When you get the results of all of these tests out, it will be very clear in the drawdown column what inputs make drawdown big and what inputs make drawdown small. Whatever you have in drawdown will correlate to the profit column, because bigger drawdown equals bigger profit, but lower drawdown equals lower profit. But you will have a massive amount of, down here, blown accounts. They will all be using high risk and close spacing, the blown accounts, because the parabolic trends, they won't survive. And then you add into it drawdown control. You will see that it's better to do drawdown control quicker in squeezes than not. But you can't predict the squeezes, so you need to find a happy medium. I'm using 6 trades. If something gets into 6 trades, I'm going to start scaling out now, because squeezes hurt. And 6 trades is roughly a good number. And the reason I know that is because the vast majority, 90% of my trades, have no more than 4 trades in a position before they play out. So if I set it at 6, I'm giving myself a little bit of a leeway for this one being worse than normal. But if it gets to 6, I'm in a squeeze. So shut and try and get out faster. Yeah. But the only reason I know this is because of testing. And I know that on average, and you can do this if you run a test in here on, I don't know what this is set up to do, but let's do on control point so it whizzes past. If you, and we need to go back in time, don't we? Because otherwise we're not going to be able to get any trades on. But if you look at it and you just watch what happens and you see the trades playing out. Did I not set this to RSI true? No, I didn't. Let's do ADR as well, just for fun, just want to get into some trades. And I'm going to get out at 1. I'm not going to use targeting. I'm going to use 0.5. Let's get in quick. Yeah, so you watch this go past and you will see roughly how many trades. You can eyeball this before it gets out of a trade, out of a position. Yeah, so if we go back, that was 2 trades, that was 2 trades, that was 2 trades, that was 1 trade, that was 2 trades, that was 1, 2, 3 trades. There was a long there and a short there, which were 1 each. Yeah, so we've had 3 trades so far over whatever time. So the maximum trades we've had in a position has been 3. Just keep running it. There was one there. That's a good one. Three trades again. 1, 2, 3, 4, 5 out. 6 is what I've got mine set to. That's a horrible squeeze. Doesn't matter, I'm out. But if I hadn't have had my target at 1 ADR, if I'd have had it at 2 ADR, like really going for a home run, which you shouldn't because it's a mean reversion. We want small targets, remember. I would have needed to take a 6th trade up there before I got out. So I still would have been out at the same rough level, but I would have had to take another one on top of it. 2, 1, 2, 3, 4, 5 out, single. 1, 2, 3, 4, 5, 6, 7, 8, 9 out. Some people will have their EA set up to not do drawdown control at all, but use 0.05 risk per initial entry, and they will just sit through this for hourly chart 1, 2, 3, 4, 5, 6, 7, 8, 9, I don't know, month and a half. They just sit through it because that's how they want to trade. Other people want more risk and out faster and are happy to do drawdown control. As I say, there isn't a right or wrong. The methodology of position trading is what it is. 1, 2, 3, 4 there is just to get in and out on price movement. But what this proves to you is that all this does is it goes up and down. And this is position trading. It goes up and down all the time. Doesn't do anything else. After it's gone down, it goes up. Sometimes it goes down for a long time, but it will go up and down on its way down. And it produces that kind of equity curve. But it will only do that if you don't do that and that and that. Oops. If I run that test again, that will blow the account. It might not do. It might make blown, bang, gone. So what does this teach us? Don't get in with 1.5 multiplier. Don't use 1/4 of an ADR spacing, and don't look for 2 ADR of movement on a mean reversion scalping trade. Yeah, pretty obvious to me, but not obvious to everybody. But this is what the back test is for: is to show you what works and show you what doesn't work. That doesn't work. I know that doesn't work, which is why I don't teach people to do that. But this is what it's all about: learning what works and what doesn't within position trading. But there's no rule that is the best. There's rules that are probably going to blow your account, probably not going to make you a lot of money. And there's other rules that are good for prop. Yeah, prop, you want high risk, low spacing, and hope to God that it just works out for a week. Totally different strategy. Never going to last long term, but what do you want to do? Pass an evaluation. That's your rules. Different rules for different circumstances. We covered that in prop when we did the little prop session, didn't we? We looked for a set file for the position trader EA to trade prop with. ADR reversals works really well. When it doesn't work, blows it. When it does work, it doesn't. But it will at some point because it's high risk. Oh, we can ask Trump. Yeah, we can always ask Trump. He'll know everything. Question was not for my positions, but as a general question for how to deal with continuous trends. Yeah. Exactly. There is, like I said, I think I've answered that, haven't I? There's no, it's not continuous trends. A trend is market structure. Yeah, that is a trend. A trend works like that. This isn't exact, but what a trend is doing is pushing, pulling. Yeah, there's a new high made, breakout, retest, new high made, breakout, retest, new high made. Breakout, Fibonacci pullback. Yeah, that's what a trend is. A trend is highs and lows. And those highs and lows are never going to be uniform. They're never going to be the same. They may be 38, 23, 50, 61, 8, 71, 9 pullbacks. Yeah, they are one of those. If it's 100% pullback, it's a range. Yeah, if it's a trend, it's pulling back to a Fibonacci ratio. or a previous level of resistance. Yeah, which is why everything I've just said this morning, that is why it works. If you've broken out, you pull back to resistance, support. Yeah, and if you're going to range, you come off of resistance. If you're not going to, you might bounce off of it and break out, in which case then that's where you buy it next time. If that doesn't work out, you buy it at the previous point we bounced at. Make your average there and try and get out on a range trade. This is all market structure is. What you're talking about is parabolic trends. There's nothing that survives a parabolic trend. If you've pressed the button in the opposite direction before a parabolic trend starts, you're stuffed. Go and look at how many times a parabolic trend happens. Yeah. How long they last. Go and look at a chart. Do this yourself. This is a great experiment to do. So this is the yen intervention. Yeah, played out on the Swiss franc. Yeah, this is a parabolic trend. Yeah, this is just absolute panic buying of the yen. Quick, buy it all. Yeah. Panic buying of the Swiss. Everybody's liquidating all other assets, putting it into the Swiss and putting it into the yen. How long did it last? Yeah, this is a 4-hour chart. 1, 2, 3, 4. Call it 5 weeks. So they've got 5 weeks there. It went parabolic. Measure the distance it moved. Yeah, and this is the biggest parabolic trend we've ever had in the yen. And again, beforehand, everyone was like, yeah, it'll never go that far. It'll never go that far. It's gone that far now. So now in the future, everyone's going to go, yeah, it'll never go further than that. It will. At some point, it will go further than that. When? I don't know. It might be 10 years, 20 years in the future. But before today, that day there, we'd never had a move that big. We have now. It lasted 5 weeks, and then you got a pullback which you could have exited. So what was your job? Survive 5 weeks and survive that distance. If you were to go back in history for 10 years on every instrument out there and go, what is the biggest? And just measure it, go like that. Yeah, could you have got out on that? Maybe. So let's say it was that before it reversed. 524. So write down 524. That's the biggest ever move I've seen on the CAD Swiss from there to there. And I wouldn't have been able to get out on that. You probably would have if you were using aggressive drawdown control or you were using lot size multiplication and drawdown control to get out of some. You probably would have been out on that. But if you weren't, that's the worst case scenario. There we go, 524. Go back in time. Find something else that's as big. That's much bigger, look. 611. So 611 is the biggest move we've ever had. And that was back in January 21. 611 we moved. So that's the biggest we've moved. Then we got a 38% retracement. Yeah, that's enough to get out. If you're scaling into a position with 3/4 of an ADR or an ADR, maybe half an ADR, 38 retracement is not just a break even, it's a profit. Yeah, that move there is multiple ADRs. ADR is 40. That is 268. Yeah, it's massive. Yeah, it's 4 or 5 ADR move. Yeah, 611. And repeat this process. Just go back and show yourself. What's the worst thing? What's the worst case scenario? 670. 590. Swiss franc peg removal. Can't do anything about that. Everybody died. Exclude black swans because I've been trading in 17 years. That's the only one I've ever seen. That's the only black swan event I've ever seen. That Swiss franc peg removal happens once. It's happened once in my lifetime. There might be another one in my lifetime, but assume you're going to get one in your lifetime. At some point, you're going to die. You're going to blow your account. Or you're in the right direction on it and you're going to pay your mortgage off. It's binary. One of those is going to happen. Yeah. But apart from that, 900. Let's call that the biggest that we've found in 20 years. Next trade you get into on the CAD Swiss, assume that the first trade you take is at the absolute worst possible place, the very, 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 very top when you are going to be buying it. at the very top, which you can't do using this indicator because it physically can't get you in at the top, but assume it's the worst and assume 910 is the way it's going to go, the very worst you've ever seen in your life, and plan your scaling for that. You'll never blow an account. You won't make a lot of money, but you will be a profitable long-term trader because this is the worst case scenario. Do it on every pair and then set every pair up. You can do this with a back tester, yeah? It will tell you you're going to be in a lot of drawdown, and you are going to be in a lot of drawdown. But you can do this very easily. You say, how much risks should I use? What lot multiplier should I use? What should be my average distancing? And what should I use as a target? Nothing else. Run this on every instrument. Get the system parameter permutation test out, and it will tell you how not to blow an account. And it will tell you how to blow an account, and it will tell you, holy crap, this is the drawdown you're going to take. But if you know what's going to happen potentially in the future based on what's happened in the past as the very, very worst case scenario, you will never have any misplaced confidence when you're trading. Yeah, this US dollar CAD move, don't know if we've ever seen it before, but the distance that we've moved now without a what I would class as a big enough pullback for a standard position trade to get out of is 757 pips. This move here was 660. This move here, that's a 38, was 880. So, you know, we are sitting at the moment at 760. We've gone 880 before. I've already found something bigger. That you'd have been out on. That, I mean, you'd have been out on that. But let's say you didn't. 660. 880 is the worst we've found. You'd have been out on that. So you'd have been from there. Maybe, but that's 500. So yeah, let's assume that this thing, US dollar CAD, is going to continue. 1,200, but you'd have been out on that. So this would be the entry. And you know, this is the worst. You're never going to get in here. You're always going to get in as it's pushing up. It's mean reversion. So really, that is where you're going to get in. 800. So let's say on average, you know, all these worst case scenarios we've seen are going to be 800 pips. So if you want to extrapolate into the future where we're going with the US dollar CAD now, it's somewhere around there. So we've got roughly that far to go. Then we've broken all-time records. I mean, I haven't gone back all the time, but yeah, plan for that. You'll never get into trouble. Never. But can you make a living planning your risk around the worst case scenario? No, because what will happen is you just won't make enough profit continuously to be able to make it worthwhile doing. You're probably better off putting your money in a savings account or buying the S&P in January and selling it in December. So you need to use slightly higher risk and slightly better conditions than the worst case scenario, because the worst case scenario you can scale out of. Yeah, and I'm nowhere near using the worst case scenario. Have you seen I got hurt here to the tune of 10%. If I'd have got in with half the risk, I'd still be in it now. But it's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 weeks, 2.5 months, parabolic. Yeah, just, you know, this is what trading is all about. It's about analyzing history to forecast future probability, but probability is random. Yeah, markets are random. There is always going to be another worst case scenario at some point. If there was a nuclear weapon fired from Russia, and if it hit Ukraine, and if a load of UK or US troops happen to be killed, it is going to kick off World War III. And this is going to do something it's never done before, because we haven't had a world war. What does the market do during a world war? I don't know. Have you got any charts going back to 1945? I haven't. Yeah. Pandemics. Never had one. 2020, holy crap. So what happens next time you have a pandemic? Let's use that as a measurement. So that should be your worst case. Let's assume in December we're going to have a pandemic. What do you need your risk to be? All you can do is go back to 2020 and go and have a look at what your risk needs to be. Your risk needs to be 1257. So 1,257 pips. That's what you need to equate for if the pandemic breaks out in December or January. So if you adjust your risk to that, you'll survive it. But you can't adjust your risk to that. It's one event that's happened once in our lifetime. It's equivalent to the Swiss franc peg removal, black swan. Unique. So you have to work with the norms, and the norms are market structure, pullbacks. So you can measure what normally happens in a very strong move. And if you base everything around that, which is what I use, which is around about 3/4 ADR spacing, because things don't normally go more than 6 ADR, 5 ADR, meaning you'll never be in more than 4 to 6 trades, you'll survive 90% of the market conditions that are out there. But if you take some manual ones in between them, just because you fancy it, it changes completely the structure of your trading, and it will give you a completely different outcome to what you're expecting. But that's what you can do. There we go. We went off on a bit of a tangent at the end there, and we've been going for 2.5 hours, so I ought to shut up. But anyway, as you've added buttons to the POS-EA, I rethought about my wish for a close long, close short button. I'm not a fan of multi-position trading, but that's something you can do manually. You don't need a button to do that. Just do it yourself. Yeah. It's something that you're doing. Anything. This is the way that I look at automated trading. Anything that you're doing manually that you want automated, if it's something that you do manually every now and again, it doesn't need automating. Yeah. So if you are going to get in long and short with position trades, and you are going to decide when to close your longs and your shorts with a button, don't be lazy. There's only going to be probably, let's say, 4 lines which you need to right click, close, right click, close, right click, close, right click, close. That didn't take me more than 3 seconds. Do it yourself. I wouldn't do it. If I was doing that, the close button that I've introduced there is for me to go, news is about to come out, I've got some profit, I want it. Yeah. Or, right, I'm pulling the plug. That's what my close button is for. Yeah. This is the EA hasn't hit the automated targets I've set it. Therefore, I am making a decision. I am overruling you. And this is just for convenience. If you had a close long and close short button, yes, you could put another one in there, but it's not going to take long. The other way you can do it is to whiz into here, go to your trades, and you can sort them by type into buy, and I can just press this little X. Click, 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 done. Literally less than 3 seconds. If it's going to take me a few seconds to do it, I'm not going to automate it. You've got to do something yourself. But anyway. There is also an option to close all, buy or sell positions at once. If you right click on the position. Is that a... Oh, I'm clicking on the average. That's not going to help, is it? Oh, what in... There isn't an MT4. There might be an MT5. There isn't an MT4. Yeah, MT5 might have, but you know, buttons. This is what the price action toolkit's all about. is having fast trade buttons for fast trading. When you're trading M5, M1 or scalping, whatever you're doing, there's an argument for having buttons for everything, because you just want to be able to go, I need to make a snap decision. Position trading H1, H4, which is where it's best done, it's so slow. Yeah, I can make a decision now, go and make a cup of coffee and come back and then press the button, and price has hardly gone anywhere. So there's an argument for certain things, I understand, but not all the time. That's just me. I want control at the end of the day. So I'm up 2.4% this week, which is good. Ignore the month total, because obviously that's because I've withdrawn out of the account and the balance has changed. That 25 grand, that was the US dollar CAD trade. High risk, high reward. High sleepless nights. Part of the job. Who doesn't have a job where they don't have things happen they don't like? This is no different. It's the same thing. Hedges. Not hedges. I'm assuming they've hedged. DAX still short break. Don't like that gap fill. 2R on it. So today the FTSE, I don't want another rotation day like yesterday. I've got a feeling we might get one because of FOMC this evening. So what I might do is we've got 289 hedged. So the low there is 186. So I'm going to just move my TPs to the downside to there. So that banks me 340. Hedge is 289. So I will hope that we get a double bottom and go into a range. Just go into rotation. So that will be paid for with that one. Nothing else you can do. The indices today, they're just a mess. Is it possible to extend the date to show P&L like the last 30 days? Probably, but no. What do you mean? What in Trade Manager dashboard? What to go all the way down here? You could do, but the reason I put that in there is because this is all you're interested in. How's this week going? How's this month going? I don't care what happened on Tuesday last week. It's irrelevant. It's gone, past. It's nothing to do with me anymore. Even this is for ego. It's not important. This is important. This is the important bit. This is just telling you how you're going. This profit plus column is what I used to use all the time. I don't use it much anymore because I've relaxed. I was trying to basically do drawdown control using excess profit because I was setting myself a profit target. You soon realize that a profit target is irrelevant in trading because there'll be days where you will make tons and there will be days where you just cannot bank because the market doesn't move. So setting yourself a daily or a weekly profit target is really irrelevant. So I just don't use this anymore. But I needed this data to calculate this. And if you extend that down 30 days, you're going to need another dashboard because it's just going to take up all the space. If you want to know that information, link your account to FX Blue or to any other trade tracker, my FX book, or link it to Forex Factory's Trade Explorer. That will list out day by day your profit. And it will even plot it on a chart and do everything like that for you. If you want to see all that data, then that's the way to do it. This is more for this. This is the important part. What's my exposure in the upcoming news and where are my problems? That's what I'm interested in. My FX book, if you go into Forex Factory, they also do them. They do what's called a Trade Explorer. So if you go, I'm not logged in, but if you go into your account, you can set up Trade Explorers. So my FX book, Forex Factory or FX Blue. FX Blue do really good ones. There you go. So here's an example one. Just lists all your trades, your statistics. winning days, all this sort of stuff, day by day. You know, it's loads. Oh, there you go. Oh, missed it. There's day of the week. Oh, that's how profitable you are on each day of the week. There's all sorts of stuff in here. This is all free. My FX book's free and Forex Factor is free. There's paid ones, but I've looked at all the paid ones. I used a system called Edgewonk, which is really good. Trading journal, but it costs money, and it doesn't give you any more information than this or my FX book. In fact, the FX Blue, I think, is probably the most detailed out there. And also, as you can see, you can export to Excel, which is great. So you can get everything out to Excel, and then you can squirt it into Quant Analyzer for even more detailed analysis. But you can get that out of your account anyway. So, but they're all good. But this is free. Obviously, it's advertising everywhere, so they're not doing very well. Whoever this person is, it's not a real account. This is just a demo one for someone. So yours will obviously look very different. Right, I'll leave it there today. Anything else you need, let me know. I'm still working on my EA4 indices. It's quite complex. So, but if you want to do support resistance based trading, it's something that is worth looking into. Because it's a very, very good way of not using indicators to do exactly the same thing. You know, our indicators are reliable when they're reliable. When they're not, they're not. Support and resistance is reliable when it's reliable. When it's not, it's not. It doesn't matter how you get in. But taking trades at logical areas quite often, yeah, will get you in later. There's no reason to get in there. There is a reason to get in there. Yeah, it didn't give you a signal to get in there, but that was the obvious spot to get in, wasn't it? Yeah. So there's, you know, it's another thing to do. So just hitting the buttons. And also, if you want to use these buttons, and this is one of the reasons I've done this session today, is because of these buttons. They are very useful. If you set a limit order, so let's say I'm here now, long. My next long trade is going in here, right on that low. But we've got a low there, a low there, and a low there. The average is somewhere there. So you know, the argument is I want to set a buy limit here. That's what that's for. And that is a perfectly viable trade. Distance between that trade and that trade is 31, which is over half an ADR. I'm happy with that. But if it does this, I'm not going to get in with the EA manually. Automated, yeah, because the EA is getting me in if price moves below there and gives me a signal below that level. However, that looks like a pretty good support area. If we retest that, I want to get in. That's what that's for. In fact, I'll leave that trade in place because it's a decent one. And we've got FOMC coming later, so FOMC may well spike down. And one of the advantages actually I haven't covered, which I'll quickly do, of using limit orders. So there's a lot of disadvantages to using limit orders, but there are advantages as well. This is a prime example. Yeah, this spike. So when you get a news happening, we get spikes on news, don't we? So it spikes through and then it pushes up. Because of that spike, you don't get any signals to get in. There's no moving average cross. There's no market reversal alert. It's a spike in the market. Limits will get you in at spikes at support, whereas all other signals won't. So that is their advantage. That would have been an entry and my average would be there, and this would actually be sitting in profit now, just shy of profit, but it would be sitting in profit now if I'd have used a limit order. So there are advantages. I'm not going to say there's not disadvantages, because there's disadvantages, but there are also advantages to using them. So you've got the choice of using everything now, and obviously now you know about how or don't know about, but you have an obvious way to identify good initial entries and then backup entries. And if they don't fall in line with what the EA draws, put your own in place. Nothing wrong with it. The EA doesn't know whether it's got the right or wrong entry. You don't know whether you got the right or wrong entry. The only person that does is the market, and it's going to tell you in the future. So set them up, get in, wait. That's all you can do. All right, leave it there. Anything you need, let me know. I'll be in Telegram. And I won't. I'll be in Discord. If you've got any comments and you're watching on replay, stick them in below. This has been a long session, probably the longest one we've had, but we're only doing 2 a week, so I don't mind overrunning on them. Thursday, I haven't got a plan for Thursday yet. So if you've got anything you want to do based on position trading on Thursday, let me know in Discord and I will do a session on that. But I'm going to be working on the EA that I'm working on for support resistance, automation trading and as well, and intraday trading. So I'm hoping I'll have that sort of ready, but if not, I'll do a session on something else. But if you want any more position trading stuff, or you want to do more of what we've done today, just playing around in the strategy tester, we can do that. Yeah. So I will be guided by the light, and you are the light. So, all right, have a good day. Anything you need, let me know. Otherwise, I will be back tomorrow afternoon for the New York session, and then back on Thursday for the members. All right, have a good one. I'll see you next time.